There we go. Yo, what's up for y'all on the YouTube replay? I appreciate y'all. I can't wait to give y'all a quick portfolio update, and I have a new stock I want to share with you guys that I just bought. I kind of talked about it at the beginning of the last stream, but I have a really cool stock I want to share with you that I just bought that I think is going to be a winner in the long run. I did some more research on it, but here's a quick portfolio update. We're actually down 0.7%, or this was on Friday, but year to date, we're doing pretty good. We're up 13% year to date. On the 1 year, we're up 16%. And here's my total percent change on every stock. So luckily, we are green on every stock. I got a lot of popular ones like Meta, Google, McDonald's stock, some popular names there. And I also have a Roth IRA. This is where I bought the new stock, so I'll come back to that one in a minute here. And then I have my buy and hold portfolio. So in this account, once I buy a stock in here, I try to literally just never sell it. So I really do my research. So I have Amazon, Coca-Cola, Consolidated, Amphenol Group, Comfort Systems, some of my favorite picks that I plan to just never sell. And then finally, I have my risk on portfolio. This is where I own a lot of growthy names. You've probably heard of like Reddit stock. I got SoFi. I got Robinhood, AMD. I've been holding a lot of these stocks for a very, very long time. Super microcomputer. So yeah. Hey, what up, Plasma? He said AMAT I'm buying. Yeah, hey, give me 1 minute here. Yeah, I'll get to the stocks you guys want me to look at in a second. I want to quickly tell you about a new stock I just bought that I think is going to be an insane performer in the long run. Not financial advice. I'd put this one on your watch list, but this is ticker symbol CRMD. I bought them on Friday, and let me show you what I love about this stock. It's their financials that really blow me away here. So I normally wouldn't recommend these kind of stocks, but here's why I think this one's a 3x potential, not financial advice. Look at this market cap in the top right. So this is a $1.1 billion company. So kind of think about that in the back of your mind. This whole company is worth $1.1 billion, and you're buying a company that has no debt whatsoever and $190 million of cash. So about like 17% of their entire market cap is just their cash on hand. And they used to have no sales. You know, if we zoom out 2024 behind, they had no sales, but now they have real sales. 39 million this quarter. And out of that 39 million this quarter, 19 million of it was net income. So this is what's crazy. They have literally 50% margins, 95% gross margins. I mean, this is like Reddit stock, and the sales are just expected to keep on growing. Same with the EBIT. Same with the net income. Net income's supposed to go to 65 cents. Dude, this company's trading at like 9 times net income. So not financial advice. For all those reasons, they have 19% of their market cap is cash with no debt, making a bunch of net income. So that's why I decided to pick up some shares of CRMD. They're only worth $1.1 billion. Yo, what up, Locker? He said, what up? Yeah, hey, it's in the link tree in my bio, that very first link there, brokerage. But check this out right here. What up, Plasma? He said AMAT. Yeah, if you guys got any stocks you want me to look at, let me know, and I can check them out for you. Here's another cool thing that this app kind of does, because I don't really do technical analysis on here. I mainly just look at the financials, but it's saying that there's a bearish continuation triangle on the chart there. So anyway, I like to judge them from their financials. And as we can see, Applied Materials trades at 19 times net income. So that's actually a pretty fair valuation, a teen multiple. So 19 times net income. Yeah, so this is a big semiconductor play. 74% of their company sales are from semiconductor systems. And let's see the bottom line here. So yeah, this is their profits, dude. They're printing money. I mean, they're making $1 to $2 billion in net income every single quarter. I mean, this is some impressive profits. What is the growth though? So one thing we would like to see is probably some higher growth. Like if we look, the sales are up 7.7% year over year. I think we would like to see a little bit more growth. And someone said Nvidia. You know what? We'll look at Nvidia too. I do like Applied Material. They're like a more value Nvidia play. So here's Nvidia stock right here. They had some phenomenal, that was actually pretty good earnings, according to the analyst. They beat on revenue, they beat on net income by a good chunk, and they beat on EBIT. So it was a triple beat quarter, technically. The sales grew 55%. Applied Materials grew their sales by 7, but this is why Nvidia has a higher multiple. They're more growthy. Sales are up 55. And look at the net income. This is the best part. I mean, they had a record net income quarter, $26 billion in net income, up 59%. I mean, this is the reason Nvidia deserves all the hype around them. I mean, look at, like, what other company could pull this off? I mean, literally in 2022, it was $11 billion for the full year. This is in fiscal year, but for the fiscal year 2025, 119 billion. I mean, this growth is just unbelievable. Obviously they have a huge GPU market share. Here's Nvidia with the 20% PC GPU market share. They're also growing their automotive business. Lucid automotive cars are using Nvidia's automotive software, which is pretty cool. But yeah, it's a huge data center play. And Nvidia is so big that they literally own some individual stocks. Hold up here. If I go over here to the Nvidia portfolio, check this out. We can see what they own. They're the largest shareholder of CoreWeave. So most of their portfolios in CoreWeave. Then they got ARM, APLD, Nebius, some of those other names. But yeah, COHR stock. Let's look at this one. Yeah, COHR. This is Coherent. Let's check it out. So this is a $14 billion company. So let's go look at their actual numbers here. So they're in networking materials. Oh, I remember this company. Yeah, they're seeing a lot of growth in their networking business. Like, check this out. If we look at it on a quarterly basis, it's up 40% from the previous year. I mean, this is what you want to see, a company growing their fundamentals. And also on an annual basis, I mean, it was flat for a couple years from 2022 to 2024, but just had a huge spike up recently. So that's great news. That's growing like crazy. Let's see. Revenue's up 16. And the operating profit, so yeah, this is really what you want to look at. They're making a lot of money right now. If we look at the actual net income, this is technically a one-time adjustment. They didn't actually lose net income. They actually made around 100 million in net income. So there was some little accounting issue there, but no big deal. So actually, they look pretty good. I like that company. All right, let's see here. What was that? Oh yeah, Intel stock. So yeah, here's another semiconductor play. Let's do it. So this company just got a huge investment from the US government. I wonder if it'll show that down here. So yeah, Intel secures the $8.9 billion government investment with a 9.9% stake. Pretty cool. So anyway, if it weren't for the US taking a stake in Intel, I wouldn't really be covering them because their financials aren't good, to be honest with you. I mean, here's their GPU market share. Went from a 66% to a 63%. So it did fall by 3%. But the unfortunate part about Intel is the fact that they burn money. And again, the future has changed because the government took a stake. That really does have a lot of value in it. But for right now, the business looks tough. If we judge them without the government deal, I mean, they're burning through money. $3 billion this quarter, $1 billion last quarter, 17 billion net income loss. I mean, I don't know what caused that. And also the free cash flow numbers as well, losing a couple billion of free cash flow quarters. So that's why Intel, if you didn't know, this is kind of sad. Intel is the exact same stock price that it was back in 1998. So imagine that. You bought the stock in 1998. You're down on your position. Pretty unfortunate. Hey, what up, Lamb? JH Games, he said METC. What is METC? So Ramaco Resources. So look at that. They've had a nice little rally the past couple weeks here. So let's go see what caused that. They had some really good earnings report. Let's see. So yeah, look at that huge beat. So the orange line is what the analysts were expecting. And whenever you beat like earnings like crazy like this, your stock price rallies up. And look at that. Analysts were were expecting 131 mil. They reported 152. So I think investors were really happy with that growth. I wonder what the industry is. Coal mining. Okay, so coal and real estate. So there's a coal play. I'd still be careful with that one. Only a $1.7 billion company, but it looks like that one's been doing pretty well recently. What up, Sebastian? He said SNDL. Is that? This is SNDL stock. So they've had a nice little rally the past couple weeks here. So look at that. But if we zoom out on the weekly, this is in a sector that we can't really cover here on TikTok, so I won't really tell you what they do. But if you look really quickly, they sell drinks. And let's see, are they making profits? Actually, this is great news. They made profits this quarter. So that was real. So they really made net income this quarter. They used to burn through money, and this was really bad, like 50 mil that quarter. 60 mil this quarter. That's really significant when you're not worth much. So I think analysts are happy. Let's see. Yeah, analysts are expecting them to continue to make positive net income numbers. So that's good news. Yeah, they're only worth 689 million. So when you lose 60 million in a quarter, that's 8% of your market cap. So hey, what up, Jacob? What's your opinion on Nvidia? Yo, we just looked at Nvidia, Jacob. We'll come back to that one in a minute here. Yo, try not to spam there. Yeah, let's see ISRG. That's Intuitive Surgical. This is one of my favorite medical device companies out there if you're looking for one. So yeah, hey, what up, Lex? We'll get to all. Well, we'll look at Tempus AI. What's up, guys? So yeah, here's Intuitive Surgical. This is a healthcare play, $170 billion company. So they're massive. Here's why I think they deserve their. I think they deserve worth looking into at this price right here. A lot of healthcare has been getting hurt recently, but check this out. They sell instruments and accessories, and this business has been growing very nicely. Double digits every year, every quarter. I mean, let's go to on an annual basis. I mean, that's the trend you want to see. Very consistent 20% growth. What about the systems revenue? That's also at a record. And the services revenue as well. They service their machines. So anyway, point being here, look at this net income number. They're making 700 mil in net income a quarter, and it's growing 20%, 25% year over year. So sales are up 21, net income's up 25. So impressive. And they have a monster balance sheet. This is the crazy part. They have no debt whatsoever and $5.3 billion of cash. So in my opinion, it's just such a safe company, so growthy, and they make these big medical devices. Like I think they make like those MRI scanners and stuff like that. So anyway, let's see here. Tempus AI. So yeah, this is a company I believe that's owned by Nancy Pelosi and her husband. And I actually see why. I really like the financials here. I've looked at them before. So check this out. They're in the genomics business, and check out the growth. I mean, this is unbelievable. This is why they deserve the hype around them. The sales are up 115%. They've more than doubled year over year. So that's what I'm really liking about this company. And it's not just this business, but the data and services business is up 35% year over year after growing 32% at the same time last year. So they're just super growthy. I love them. Yeah, if we just go to their total sales right here, it's up 90% year over year. They are still losing net income, but it's okay because they're so growthy. So what was the healthcare stock? Yeah, that was ISRG. By the way, if you missed anything, I'm also streaming on YouTube. That's the best way to support me. Watch my stream from YouTube. I'm trying to build out my channel there. I sell nothing. I have no course, book, Discord, WhatsApp, Telegram. Watch out for people impersonating me, but I do have a YouTube channel. It's called Nathan Robert. You can just type it in YouTube, or it's in the link tree in my bio. So and I'm streaming on there. If you miss anything, you can watch it on the replay. So here's Snowflake. This is kind of like a Palantir competitor. And there's some good news and bad news about this company, but they had some really good earnings. Let's see what they were actually. So yeah, they had a nice beat, like 10% plus beat on revenue. Yeah, this is really the best part. They're narrowing their net income losses because this company is burning through net income. Look at this, a couple hundred mil a quarter, and I don't love that. That's the one thing that I like stay away from. That's why I stayed away from Snowflake, because they're just burning net income. But it's narrowing at a faster rate than analysts expected, and sales are up 31% year over year. That's why they're making free cash flow every quarter, but the net income's negative because they have so much stock-based comp. But here's what I love about them. They're so growthy. I mean, if we look at the sales, it's almost $1 billion this quarter. It was at 996. They're almost at their first ever $1 billion quarter. If we look at this on an annual basis, I mean, this is the trend you want to see. I mean, that is some impressive growth. So yeah. Hey, what up, SIPC? So yeah, hey, this app, I'm on a brokerage right here where you buy stocks and stuff. If you want to get this little app I'm on, it's in the link tree in my bio. Very first link there. So yeah, it's my favorite app for analysis. Hey, Agnico17, thanks so much for the gift there, for the rose. Let's check it out. You said Card Factory. Do you mean Cake Factory? Or the Cheesecake Factory? Let me know if you're talking about the Cheesecake Factory, and I'll check it out for you. I got you. So let's see here. I'm up 13.5x in 6 years. Hey, that's great. Marvell PE ratio is actually negative. So it shouldn't be. Or its forward PE shouldn't be. So let's see Marvell Technologies. Yeah, if we look at the very top middle here, the PE, it says a loss because they don't make any net income. But they actually do. So check this out. If we go to their net income right here, this actually, it's barely a loss. So look, if we do 200 mil, 200 mil, 200 mil, then in this quarter right here, they lost 600 million. So as soon as this quarter is gone and we add another 200 million right here, they're going to be making 46, about $1 of EPS. So they're trading at, this company, in my opinion, just off my little analysis, is trading at about 32 times forward net income. And you know what? Let me go verify that. Let's see how accurate that is according to the other analyst. MRVL, what's the forward PE they say? They say the forward PE, if you look on the left there, is a 22. So my math was at 32. This app is saying it's a 22 times forward net income. So anyway, that's how That's how I look at that. So let's see. Hey, someone said Card Factory, UK stock. Huh, what's the ticker symbol for that one? I can maybe type it in for you. Card Factory. Yeah, I don't know if I can view it if it's a UK stock. I do apologize there. Thank you again so much for that little gift there. If you got another stock you're going to look at, let me know. Or maybe I can find that one if you give me the ticker symbol, but I don't know if I can because it's on a different exchange. But someone said NU Holdings. This is an they're a US-based company, but all their revenue comes internationally from really South America. So this is a crypto-adjacent play. It's actually a crypto bank out of Brazil. So check this out. If we look at where the revenue comes from, 92% of the revenue comes from Brazil, then Mexico, Colombia. But they have a crypto bank in South America, and that's where crypto is so popular for transactional uses because their currency is not too great down there. And this company has great net income numbers. It's up 30% year over year. I mean, these are just fantastic. So for those reasons, I actually really like NU. They are exposed to crypto, but someone said, I heard Warren Buffett sold out of NU. That would be very interesting. I'd believe it. But yeah, Warren Buffett sold out of a lot of stuff like T-Mobile. I own T-Mobile. Yeah, hey, I haven't even been doing the portfolio update that I wanted to get to. Yeah, here's my main account anyway. Yeah, there's my 5 shares of T-Mobile stock. Okay, someone said, which one should we look at here? Brian said Broadcom. Yo, let's do Broadcom. Yeah, I love this company. So another semiconductor play. A lot of people know them for their semiconductor solutions, but one of the best growth factors for them has actually been their software business. And this is really high margin for them. And look at how growthy it's been. You know, it used to stay at this like $2 billion level. Now it's exploded $6.6 billion just this quarter. So their software business has led to a lot of their stock price appreciation and their printed money. I mean, the actual free cash flow numbers is $6.4 billion, up 44% year over year. Sales are up 20. They're making like $5 billion net income a quarter. So I love Broadcom, and you get a yield. It's like Nvidia with the yield. You get a 0.8% dividend. Pretty good. So Open Door, you know what? We'll do Open Door. Let's do it. So Open Door Technologies. This is kind of a momentum play right now. This company is really begging for lower interest rate environments. What this company does is they just flip houses. It's simple as that, you know. And look what happened in 2022 with this low interest rate environment. I mean, they were doing $4-5 billion in revenue a quarter. Well, now, you know, high rates, boom, sales went under $1 billion, fell 70%. Now it's at 1.3 billion a quarter. So they're really begging for low interest rate environments. They just cut a bunch of staff. They fired a bunch of employees to cut down on their net income losses, and this seems to be working. I mean, they only lost 29 million in net income. That's good news. So anyway, I would just stay away from that one, you know, but could be a fun little momentum swing trade or something. I would avoid that one just holding for the long run. Doesn't seem like a great company. Let's see, FND. What is it? What up, TM? He said FND stock. So this is Floor and Decor. So it looks like they're maybe going to trade with the home builders. So they're a big company, actually, an $8.8 billion market cap. So I know a lot of the home builders have been struggling. So in the residential sector has. So let's see, laminates and vinyl, tiles, installation material. How's their tile revenue doing? Let's see. It's on an annual basis. Well, look at that. You know, it's seen some nice growth, actually. Anyway, let's just go to the total sales down here. So, bro, I did not mean to click that. Sorry. Let's go see their total sales year over year. I bet it's not doing too great if I had to guess. But, actually, no, it's pretty good, actually. Or single digit, it's up 7% year over year. So the sales are up by 7% year over year. The net income, they're making not great margins. Like a 6% or 4% margin. But they're still making net income every quarter, 200 mil a year. So that's good. What are they trading at in terms of valuation? 42 times net income. I mean, nothing's really just blowing me away there. I mean, hey, they're like a residential housing components company. So let's see, TSSI. Yeah, hey, this company's been struggling. I actually sold out of this company. Could you do Wahed F? What's the ticker symbol for that ETF right there? It's a boring ETF. I don't know what the ticker symbol. Hey, what up, Mal? Yeah, we'll look at mRNA, TKO. What's up, Ruben? So here's TSSI. Here's what I like about this company. I normally don't talk about these kind of stocks. Hey, what up, Josh? Good afternoon. So look in the top right. It's a $378 million company. So that's a very, very small market cap. The company's only worth $300 million. But out of all the $300 million companies out there, I like this one because they're profitable. They're actually making net income every quarter, and they have good sales growth. The sales went from 12 mil to 43 mil, a 3x plus increase. So that's what I like about this company right here. So they are still a bit risky. They got some debt, but I like the growth trajectory currently. Yeah, they're so small. We don't get any analyst expectations here, but yeah, $378 million market cap. Out of all the 300 mil market caps, I do like that one. So mRNA, yeah, this is a healthcare company right here. So this is Moderna. Let's see how they're doing ever since the COVID. So yeah, dang, look at that, man. That's not great. The stock is pretty much at an all-time low. So I feel bad if you own this one. What's the market cap? They're still a $9 billion company. They still got a little bit of market cap, but yikes. I think I found out why this company's been struggling so much. So the sales are down 41% year over year, only 100 mil, 100 mil. Looks like these 2 quarters are huge for them, but it's just like, oh, dang, look at what it used to be, man. 6-7 bill a quarter. Now it was just a measly, 100 mil this quarter, 100 mil last quarter. So it looks like, and oh, this is terrible. So remember, the whole company is worth 9 billion. Well, they've lost about nearly 3 billion of net income in the past year. So, and look at that. Look what that's doing to their balance sheet. It's just slowly going down on the assets. So I'd be careful with this one. I can see why they're not doing too well, to be honest. So here's a very interesting stock. This is TKO. They have the perfect ticker symbol. So this TKO actually owns WWE, World Wrestling, and they also own the UFC. So pretty cool business. They license out the rights to these shows or streaming service to companies, and they just collect a lot of high margin license fees, basically royalties. So they're at an all-time high. So what are they worth? $38 billion company. Wow, look at those net income numbers. I mean, it's at a record. Sales are up, holding on to that gain. Geez. So anyway, pretty cool. That's TKO stock. That one's at an all-time high. Congrats if you own that one. So HLAL, what's this one? HLAL. So listed fund Wahed F. So let's see what this ETF owns. So that's what makes up this. So here is what they own. The largest holding is Microsoft. You put $100 in here, 15 goes to Microsoft, 14 to Apple. Then interestingly, it's then Meta, then Google, then Tesla, and then you got some weird ones like ExxonMobil, J&J, PG. So they probably have a decent yield. A 0.63% yield, but that's like an alternative to the S&P 500. That's pretty interesting. Like the live, hey, I appreciate you, IROX. Appreciate that. Let's see, AMPX stock. What's this one? Hey, what's up, Celebrate? AMPX. I hope y'all are having a great Saturday. So here is AMPX. They're a very small company and only an 880 mil market cap. So they're not huge, but they've had a nice little rally recently. Let's go see if it's justified. So they sell battery segment. Only 34% of the revenue comes from the US. So they don't have much sales, but looks like the sales are projected to keep on growing. It's supposed to double. Look at that. 2024 Q4, 2025 Q4, expected to go to 10 to 20 mil. So they're expected to double the revenue. I get law of small numbers, so that's not too difficult, but it's good to know that, and they're barely losing any money. They're narrowing their losses, and even if so, they're barely losing any money. Really good balance sheet as well. So this one's actually pretty interesting. As long as they can keep up that sales growth, it's so tiny, so it's so risky, but I could see why they're doing pretty good. They're probably worth 800 mil plus. So pretty cool. All right, so IB in stock. So what is this one? ICICI Bank. Okay, let's check it out. These banks have been doing great. If you look at JP Morgan, Goldman Sachs, they're all close to all-time highs. This is a huge market cap. $113 billion market cap, trading at 19 times net income. Where does their revenue come from? So domestic operations. So look at this. We have to convert their currency. So this must be an Indian bank right here. So we'll convert their currency to USD. So look at that. They're in retail banking, treasury. They're in life insurance. How's the life insurance doing? Not too bad. So just an Indian bank. Let's see the actual net income numbers down here. They're making 1.6, 1.7 billion of USD net income a quarter. Pretty good. Oh, hey, what up? Hafiz said DCTH. This is a stock I own, by the way. If I go over back to my Roth IRA, um, I don't normally ever recommend these kind of stocks, but here's what I found so interesting about DCTH. Here's why I'd never normally recommend this kind of stock. It's just like it's down 100% all time. They're only worth a couple hundred mil, but here's why it's worth a very, very small position. If you're like, hey, this one is pretty cool, which you should make it as a very, 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 very insignificant position in your portfolio. So look in the top right here. They're only worth $385 million. So kind of think about this logically here. They're only worth $385 million and they have $81 million of cash on hand with no debt at all. So it's a debt-free company with $81 million of cash. So 25% plus of the market cap is just cash, and they're growing like crazy. This is why right now it's the most justified time to buy them ever, because before today they had no sales, 400,000 of sales. Now they finally got FDA approved and can sell their product. Now the sales are exploding higher. And not only that, this is the other best part. They're profitable. They made 3 mil this quarter, a mil last quarter. They're projected to keep on making net income every quarter. And also they have so much cash on hand that they're making interest. So $81 million of cash. Let's see the actual interest numbers. So yeah, 650,000 of pure interest this quarter. That's straight to the bottom line. 600K last quarter. So that's really significant when you're a very small market cap like them. So out of all the $385 million market cap companies out there, I decided to pick up this one, but I only bought $150 of the stock, and I am down on it a little. So again, none of this is financial advice. I'm no expert, but yeah, that's why I picked up that one. The financials are pretty decent there. Yeah, if y'all are enjoying, please hit the like on the stream for me. Yeah, watch out for people impersonating me. I'll never DM you, follow you. I don't sell anything. No course book. Hey, what up, Paul Brown? Appreciate that. Is Ave Point a buying in? Oh, yeah, you know what? Y'all are talking about all the stocks I own. So here's another stock that I own. Let's do it. So this is INOD. This is Inodata. This is another hidden gem that I think's out there in the market. I do own them. So so I have 9 shares of them. It's only worth $342, but here's why I think it's still a buy. If you go to the 5-year chart, you'll see they're up 1,500%. Here's why I think there's still a buy even after their huge rally. I don't think they're done. So look at the market cap in the top right. They're only worth $1.2 billion. So I feel like there's so much room for them to grow that. It's not like Nvidia. It's like Nvidia's worth $4 trillion. For you to double your money, they have to go to $8 trillion. Well, for this company, it's not like that. So they're only worth $1.2 billion. And look at this net income multiple. That's what PE stands for. It's the price of net income plus any share buybacks or dilution. So it's actually good that this includes the dilution. They're trading at 29 times basically diluted net income. And here's why I think it's justified. They're growing like crazy. The sales are up 99% today, or sales are up 99% year over year. So incredible growth. And this is all organic. Like they didn't acquire a business to get this. 5 of the Magnificent 7 are their customers. So Apple and Tesla, all the other Mag 7 are customers. Like Nvidia's a customer, Microsoft, Meta, Google. Also, their agility business is growing nice, double digits. I actually just made a YouTube video about this stock. But another great thing, $1 billion company, they're making net income every quarter. That's great news. So, and they have a really good balance sheet. They're deleveraging. The liabilities used to be 57% of the assets. Now it's only 34%. Yo, what up, Ace? Good to see you, brother. So yeah, I love them for the growth. The sales are growing. They're making net income every quarter. Sales are up 80%. Made $7 million net income on that. So for those reasons, and no net debt. This company has no net debt. 5 of the Magnificent 7 are customers. I love them. They're like Scale AI, which Meta just acquired. I think they could get acquired too. They're a potential. Harry, what up? He said hood stock. Yo, that's this. So here's the actual Robinhood app. This app is publicly traded, and I do own their stock, by the way. It's actually my best performing stock ever. I regret every share I've ever sold, but I'm up 659% on Robinhood. I bought this company literally at the IPO. So you should show my buy orders if anyone's curious. Probably no one does. But yeah, there were my buy orders. So I've been holding on to Robinhood literally since its IPO. Let me share with you why I regret every share I've ever sold. This is such a great company, so innovative. They deserve to be $100+ a share, in my opinion. I wouldn't buy it necessarily at $100 a share, but here's what I love about them. First off, the growth of the business. So after growing 40% the previous year, sales are up another 45%. So they're doing nearly $1 billion of revenue a quarter. But look at this quarter. They did 989 mil, and out of that 989 mil of revenue, 390 million of it was net income. They have ridiculous margins. 85% gross margins are up there with Reddit. They just collect high margin brokerage fees and interest income. So they have 40% net margins. That's just like Interactive Brokers and Futu, these other brokers. So Robinhood is just such a great one. And they move with, a lot of the revenue comes from crypto transaction fees. That's why they kind of move with Bitcoin sometimes. Hey, Jeff Mack, good to see you, man. Happy Saturday. Shout out to the member, Jeff Mack. So she's the only member, actually. But here's American Eagle. This is an apparel company. So they're not huge. They just sell a commodity. They're only worth $2.25 billion. But actually, let me zoom out. So check this out. American Eagle is the same stock price it was back in 2004. Yikes. So they've been flat for a couple decades. So let's see how the actual numbers are looking. So revenue is down by 5% year over year. So they're kind of not growing. So sales are down by 5%. It looks like they lost them. That probably is a one-time adjustment. Here's how we can tell. We go to the operating profit. Ooh, so it was a real loss. Never mind. But normally, assuming they don't do that, they usually make around 80, 90 mil of net income a quarter. So to be honest with you, these apparel companies, they could just turn into like an Under Armour. You can't really make that much money on these kind of stocks. If like these apparel companies, like if we go to American Eagle just on an annual basis, like they can't double this revenue to $6 billion like a software company or like another company could. So I just stay away from those apparel companies. Plus they don't pay a dividend. The sales are negative. So I'm not loving that one, to be honest with you. What up, Steven? He said CNH stock. What's this one? Let's check it out. So CNH Industrial. So this one's not doing too great either. They're the same price as they were back in 2003, just like American Eagle. So let's go see why. Usually we can figure out why these companies are struggling by their financials. So they are in the agriculture industry and construction. Let's go see the actual sales though. So yeah, look at that. This is what you'll typically find with stocks that have really bad looking stock charts. Usually the actual financials aren't great. The sales after falling 16% the previous year are down another 15%. And the net income is down 46%. So what that means is they're losing their margins. The margins fell by 40%. That's terrible news. So at least they're still making a couple hundred mil a quarter. But I don't think investors are too happy that the sales are down 15% and the margins are down 37%. So that makes the net income to go down by 50%. I'd be very careful with that one. We want to see them kind of recover. Do United Healthcare, any good dividend stocks? One, actually, what? I haven't looked at this stock in a long time. This is my second highest yielding dividend stock. Or I can show you this one. This is if you want a pure dividend play. Here's Main Street Capital. This is one of the few stocks, if you like dividends, that actually pays you monthly. So this stock right here, MAIN, pays a monthly dividend. And it's actually easily... They can afford to raise their dividend as well. So if you look in the top middle, they have a 4.62% dividend yield. So you get a near 5% dividend. They're one of the companies that have to, by law, pay out most of their taxable income in the form of a dividend. And they pay you every single month 25.5 cents. So you basically get a quarter a month for every share that you own. And here's how we can tell if they can afford that dividend. We look at the net income they make per quarter. And so we got to quarterlize the monthly dividend. So basically... Sorry if I'm complicating this. The quarterly dividend costs 79 cents of EPS. Well, they're making over $1 of EPS a quarter. So the dividend is very safe on Main Street Capital. So that's why I own them. And they've had some nice stock price appreciation. So that's a dividend play. AEO does pay a dividend. Oh, I didn't realize that. My bad. Do United Healthcare. So yeah, let's look at United Healthcare. Warren Buffett just bought the dip on this company, and that's why they really had this huge rally right here. That's what this gap up was from, literally just on the news of Warren Buffett buying, because Warren Buffett, he always does his due diligence and his research whenever he buys a stock, and looks like he wants exposure. So the multiple is pretty low. They're trading at 13 times net income. That's because the future is so uncertain. We're a customer as well. We use OptumRx, and this revenue is at a record $38 billion this quarter, up 19%. mean, this annual trend is so impressive. But yeah, they're making a couple bill in net income a quarter. The net income is expected to fall 50% and stay around this $3 billion level a quarter, which is unfortunate for the next year. But you get a nice yield here, a 2.8% dividend yield. So I think that one's worth looking into, under $300 a share. And if you buy it, I wouldn't make it as a huge meaningful position. I don't think I don't think it's worth having it as a meaningful size position. What do you think of SCHD? What up, Obscure? So yeah, this is an ETF right here. So yeah, if you're looking for like a basket of stocks, if you don't want to take too much risk just owning one individual dividend stock, you can buy this ETF right here and it breaks your money up for you. $4, if you put $100 in here, $4.30 goes to Chevron, then Mo, then Pepsi, then ConocoPhillips, AbbVie. These are all some of the higher yielding names. So if we go to this ETF's dividend, you get a 3.7% dividend yield. Pretty cool. So you buy that as like a dividend growth ETF. That one I don't expect to outperform the S&P 500, but it's nice diversification. Not saying Hood pays dividends. Yeah, Hood doesn't pay a dividend, but they make up for it with their very nice stock price appreciation. What up, Welco? What's up, man? AEO is struggling to expand some of the revenue from the Middle East. Hey, what's up, Brick? Best of luck too. Look at SLB. Is that Slumber? So a lot of people call this Schlumberger, but this is Slumber. This is an oil and gas company. So these oil and gas stocks don't really outperform in the long run. Most of the returns, or like 50% of your returns, are going to come from dividends. So the stock is the same price that it was back in 2005. But if we go to the yield here, you get a nice 3% dividend yield, safe payout ratio as well. But yeah, they're trading at 12 times net income because they just sell a commodity, oil. So production systems, well construction, reservoir performance. I like how diversified that they are. Looks like only 15% of the revenue actually comes from the U.S., or about 18% comes from the U.S. But yeah, they're making a lot of net income easily. Look at that. If you kind of average it out here, like $1 billion in net income a quarter. Sales are down 6%. That's just because the price of oil is, this summer oil prices were surprisingly weak. So that's kind of just being seen through Exxon and all the other ones. But yeah, out of all the oil and gas picks, to be honest with you, if I had to pick an oil and gas stock, I would probably go with an Exxon or an EOG Resources over Schlumberger, but they're still good. They're a less U.S. play. Can you give a stock that'll increase almost 70%? If I knew that, so I always have stocks that I think are going to return like 30% plus a year. My most recent stock, I believe that's going to return 30% plus a year, is CRMD. And as much as I'd like to believe that, I can never make him as a meaningful size position. And that's what I do with a lot of these stocks over here. I believe Robinhood, SoFi, Reddit, AMD are going to return me 30% plus a year, but I don't make them as meaningful size positions because you just can't trust yourself like that. You got to stay diversified. So you just buy a bunch of the companies you think will do great. So in my most recent stock that I think is legit going to return, I think is a 3X, not financial advice, is CRMD. And I only have $160 of it, but I'm about to make a YouTube video about them. If you're curious, hey, best way to support me is check out my YouTube channel. It's called Nathan Robert. It's also in the link tree in my bio. You can just type in YouTube, Nathan Robert. Hey, what up, DG? Good to see you. Can we look at Snowflake? Hey, yeah, we'll look at Snowflake next. We looked at them not that long ago, but I got you. We'll look at Snowflake. They just reported some earnings, and they were pretty good. They narrowed their net income losses faster than analysts wanted. Remind me to cover that one, and I got you, DG. Here is, though, where is it? There's Kathy Wood. So this next stock, what up? User one said, can we look at Shopify? I got you, man. I hope y'all are having a good Saturday. If you want to hit the follow button, we stream every day. Tomorrow's stream, we do 2 streams on Sunday. Sundays are the most active. But here's Shopify right here. This is an incredible growth company that I regret not owning. I use Shopify. I used to have a Shopify shop, and they would take like 0.5% of every transaction. Their margins are incredible. And look at this annual trend. This is a growth company, bro. Like in 2019, the revenue was $1.58 billion. Now it's $8.88 for the full year 2024. I mean, this is the trend you want to see for a company. Just hit a new record every year. And it's not just the sales at Shopify that are growing. It's also the actual, profits, like free cash flow. That's what FCF stands for. They're making hundreds of millions of free cash flow a quarter, hundreds of millions of net income a quarter as well. That's not good. Oh, please. Okay, hey, sorry. My Wi-Fi just like unexpectedly cut out there. I should be good. Um, so if it was laggy, it's on me, not you. We should be good though. Okay, so anyway, yeah, and their Shopify's also making a couple hundred mil of operating profit a quarter. So, and they have a fortress balance sheet. Yo, look at this Shopify balance sheet right here. They actually have no debt at all. Let's see how much cash. They have $5.82 billion of cash, no debt. Man, Shopify is a monster. Shopify is a monster. Yeah, hey, Cube is another great REIT dividend play. CUBE, Cube Smart. PGR has been so good to me. Yeah, hey, what up, Georgia? I also own some Progressive Corp, but this is a company, and then we got to look at Snowflake as well. This is a company I do own, by the way. I'm up 0.26% on it, so I haven't done great. I haven't made some insane returns on Progressive, but I think this is one worth having exposure to just buy and hold forever. You know, and this is a name that we can trust, in my opinion, because of the financials. They're so growthy, man. Like the quarterly revenue is up 23%. This is an insurance company, so the premiums are up 23% year over year. Incredible. And that's 81% of the business. And if we just look at the total revenue's up 19. Oh, it's doing it. Let me switch to quarterly. Look. Sorry, I keep saying look. This net income quarter was ridiculous. $3 billion in net income this quarter, $2.5 billion last quarter, $2.4 billion. So they're printing money. And if we look at the net income multiple, if you want to see how expensive they are, they're trading at 13.9 times net income. So pretty fair valuation. All right, so let's see. Ford is a 6.4% yield. You know what? Let's look at Ford. And well, what up, Jace? What's up, dude? He said SEZL. Yeah, we got to look at SEZL. Good to see you, Chase. So here's Ford Motor right here. So one thing I will say about Ford is they haven't done too good in actual stock price. Like Ford is 50% lower than it was in the year 2000. But one thing investors really like about them is their dividend right here. That's pretty sustainable. Check that out. A 6.4% dividend yield. And here's how we can do the math for ourselves to see if this dividend is sustainable. One thing that does worry me is the net income did go negative, but it might have been a one-time adjustment. I don't know. But let's see how much the dividend cost every quarter. They're making around like 600 mil of net income a quarter, and the dividend cost 600 million of net income a quarter. I think they did a special dividend this quarter. But yeah, the dividend cost 600 mil, so they at least need to make 600 million of net income, and they didn't these past two quarters. So I would be a bit careful with that on Ford. Wish I got more Shopify. Me too, bro. Me too. So let's look at Snowflake right here. What's up, if DG? So here's Snowflake. Quick question. When you buy stocks, you just look for good companies. You just think the price is reasonable. Yeah, I do care about valuation. A lot of my stocks I'm up a bunch on, and I wouldn't buy a lot of the stocks that I do own at right now prices. So here's Snowflake right here. This company just reported earnings, and they had some pretty good numbers. They beat on all the analyst expectations. They beat good on revenue. That's the orange line there was the analyst expectation. They beat on revenue. They beat on net income losses, and they beat on EBITDA. So it's pretty good. So if we look at this net income right here, the losses narrowed by 6% year over year. That's more than what the analyst expected, which is why I think the stock is rallying. They're also just really growthy. They also beat on sales. So sales after growing 28% grew 31%. So very good sales growth. But we want to see them start to narrow these net income losses because they are losing quite a bit of money from their stock-based comp. But Snowflake, good numbers there. Let's see. Which one should we look at? Oracle, please. What up, Lil Monk? Yeah, let's do Oracle. This is that cloud play. So if you're looking for a big cloud and license play, come on, ORCL. There's Oracle. So my Wi-Fi is a little slow right here. I do apologize. So here's Oracle. Yeah, they had a nasty little red candle on Friday there, down 6%. Let's go see how the business is doing, though. So yeah, 85% of the revenue comes from their cloud and license business. Pretty good. Their most recent earnings report was great as well. They beat on revenue. They matched on net income. Nice beat on EBIT. But this company, Oracle's making a nice like $3 billion plus a net income a quarter. Really good. So, and you get a pretty decent yield, a 0.75% dividend yield. Yo, no way. Yo, thank you so much. Yo, shout out to Looney on the YouTube stream. By the way, if y'all want to support me, best way to support me is just watch the stream from YouTube. Looney left me a $5 super chat. Thank you so much. He said, can we look at WM Waste Management? For sure, bro. Thank you so much for the $5 super chat. I really do appreciate that. So here's waste management stock. Let's do it. So this is like one of the safest plays out there. If you just think about it logically, like we're always going to need to throw away a trash. I mean, America just has trash. We're wasteful. So let's see. Yeah, 95% of the revenue comes from the U.S. and they're so big that not Warren Buffett, Bill Gates owns a lot of the shares. Bill in the Melinda Gates Foundation owns 8% of all the shares, but they just make consistent profits. 700 mil plus a net income every quarter if you kind of average it out there. You also get a great yield, a 1.4% dividend yield. So waste management, I think, is just a never sell stock. You don't really trade that one. You just buy and never sell it. That's an own, don't trade. So yeah, careful of the gap on Snowflake. Yeah, I would be careful buying Snowflake at this valuation after they're already up so much. He said SMHX. Oh yeah, so here's the Fabulous Semiconductor ETF. Let's see. Let's go to the top holdings here. So it looks like a lot of Nvidia plays. So you get Nvidia, Broadcom, ALAB, you get Astera Labs, Synopsys, Cadence Design. Cadence Design is a great company I wish I owned. Let me actually put them back on the watch list. Monolithic Power. I've never heard of Rambus. It's like that one's at all-time highs too. But yeah, that's a pretty cool ETF. If you don't just want to maybe buy one individually. Yo, Catherine. Hey, what up, top boss? Catherine said SoFi stock. I love this one. I do own them, so I might be biased. This is another one that I regret every share I've ever sold of on SoFi. It was hard. I shouldn't have at the time, but I was up like 200%. So I decided to take a lot of profits, but now I'm up 330. Anyway, for SoFi though, they deserve to be where they're at today. And by the way, I bought this stock literally 2+ years ago. I think it was all on this day right here. Yeah, I bought all my shares basically on January 2023. So it's been a while since I've even touched SoFi. Besides sell them. But I love this company. They deserve to be where they're at today. They're a fintech. They have their own banking charter. They have this financial services business that's growing like a monster. It is up 105% year over year. It's more than doubled. That's incredible growth on the financial services. If you look at it on an annual basis, I mean, in 2020, the full year, it was only 11 mil of revenue. And now it's nearly $1 billion in just 4 years. So they're just creating some innovative products. Same with the lending business. This is 51% of the revenue. Nice to see that this is up 30% year over year as well, also to a new record. And people are just really starting to take SoFi serious. They're making net income every quarter. They're super growthy. Sales are up 42. They made 100 mil in net income on that. So SoFi, I love them. I'm not exactly a fan of buying them at 25 plus stuff, but what do you use it for? Yeah, hey, by the way, I'm on a brokerage right here. We buy stocks. It's in the link tree in my bio, the very first link there. Do you believe Morningstar research? But do you believe in Morningstar research? Are they valid on company value? Sometimes, it's just one guy's opinion. But Morningstar, funny enough, is actually a publicly traded stock, ticker symbol MORN. Actually, with this app right here, we can even see the Morningstar research on a stock. Dang, Morningstar research doesn't have Morningstar research on their own stock. But yeah, you know what? Let's go look at Apple, for example. Obviously, this is easy pick here, but yeah, here's what he's talking about. This app, we can see the Morningstar research, and here's what I mainly like to look at. It's a short little explanation of what are the bulls saying about Apple and what are the bears saying about Apple. Like Apple is prone to consumer spending and preferences. Anyway, I do like Morningstar research, but I never fully rely on it. So let's see here. What will you buy when market is red? I'll probably buy more of the stocks I already own, but one stock I did buy on Friday is CRMD. If you watch the very beginning of the stream, I do a full deep dive analysis on the stock. I think it's a 3X, now financial advice. But yeah, anyway, yeah, I'd buy probably some more McDonald's stock and Google. I want to really get up to 20 shares at Google. I want to buy more Amazon. Amphenol, Coca-Cola Consolidated. Yo, whenever I buy a stock, you can see on my dollar cost average. Like, look at this. I've been buying the dip like crazy, like every couple of days on Coca-Cola Consolidated. And remember, I recommend if you want to get exposure to a stock, you should slowly buy into it. You should dollar cost average. Instead of just spending all your money at once on one day, it's a more disciplined approach to slowly buy it. But that won't always save you. Like, look at this stock right here. I am down 50% on this company right here. So always do your own research, continue to do your research to see if you really want to keep buying into it. Okay, someone said Samo said PayPal. Will they reach 300 again in the future? So yeah, 2021 was crazy. This looks just like the chart of DocuSign or Roku or Peloton. A lot of stocks went nuts in 2021. But yeah, they own some interesting things, like they own Venmo, they own Honey, their Chrome extension. But one thing, investors want to see the growth really come back to PayPal. Like, they're trading like a commodity right now. If we look at this multiple, they're trading at 15 times net income. That's like a multiple where it's not really expected to create or lose you any value. I think it's because of the slowing growth. Like, the sales are up single digit. I mean, sales are up 5% year over year. It was up 1% last quarter. But the best part about PayPal, this is the one reason why I think PayPal is a buy. Not a huge chunk in your portfolio, but is worth holding on to and not selling out of, is because of their capital allocation. They are literally spending all their money solely buying back their own stock. That's this number at the top here. They're spending over $1 billion of net income a quarter buying back their own stock. And here's what that does for you as a shareholder. So look, I'll keep it super simple. Net income is up by 11.7, but net income per share is up by 19. That's the power of the share buybacks. That's incredible. You literally own 7% more of the entire company than you did a year ago with the same amount of shares. Incredible. So yeah, what stocks do you own? Yeah, hey, if you go to my YouTube channel, by the way, you can see my whole entire stock portfolio update. I do have probably too many stocks. I have 3 different portfolios here. Yeah, my YouTube channel is called Nathan Robert. It's also in the link to my bio. And oh my goodness, thank you so much to the YouTube stream. And Looney, he sent another $2 super chat. Yo, thank you so much, Looney. I really appreciate you, man. He said, can we look at TTWO? Let's do it. Is SoFi too expensive to buy? I think so. I do think SoFi is too expensive to buy. And what's the difference between Coca-Cola? Yeah, so this is the bottling company for Coca-Cola. They bought the affiliate rights to Coca-Cola for $1, like many years ago. So this company can just make and bottle their own Coca-Cola products and just sell it anywhere they want, and just collect all the money for it. So TTWO, Coca-Cola owns 25% of all the shares though. And I'm going to make a video about why I love that stock. But yeah, this is Take-Two Interactive. If you heard of Rockstar Games, which is GTA 5, Red Dead Redemption, they are about to release GTA 6 and in the next year. And that's why the stock has been really rallying recently. The financials haven't been too good recently. So if you're wondering why the stock's been going up, it's anticipation of the revenue they're about to print from GTA 6. They're in such a unique position that whenever they release this asset, this game, it's instantly going to bring them in billions of revenue. Looks like analysts don't know when to expect GTA 6, but they could make so much money from this game, like literally billions and lifelong subscription revenues in the future now from this game. It's supposed to be in the top 5 biggest games ever in history. So GTA 6 is why the stock has been moving so much. So yeah, if you want exposure to that game right there, they're looking great. Another gaming stock is EA. Actually, you guys want to know my favorite gaming stock of all time? They're actually not American, but if you're into video games, is it not going to pull up the stock? TYCEY. But Tencent, bro, why isn't it pulling up? Oh, there it is. So yeah, this company right here, they're Chinese, but they own Riot Games. So they own League of Legends, Valorant. This company owns Supercell, which is Clash of Clans, Clash Royale. They own PUBG. They own 50% of Epic Games, which owns Fortnite. So this is a game conglomerate. If this was an American company, they'd be a Mag 7. But Take-Two is huge. And let's see, is this Trane Technologies? So yeah, this is Trane Technologies. I believe they're kind of in the home builder industry. Oh yeah, we can look at Duolingo, Netflix. I love them as well. So here's Trane Technologies. I believe they're a home kind of, or I don't know, let's see, equipment revenue. How's that doing? So that's up 5% year over year. Services revenue, that's up 14% year over year. Let me go check exactly what industry they're in. So building products, okay. Solutions for buildings, homes, and transportation. All right, cool. So that's why I kind of remember them being in the home builder industry. So wow, look at the profits they make. That's ridiculous. 900 mil of after-tax net income this quarter, up 16%. Look at these year-over-year growth rates of the profits are probably the reason this stock has done so monster. I mean, all-time high, pretty much. Insane margin expansion. Yeah, margins are growing 25% year over year. Do you get a dividend? Yeah, you get a 1% yield. Are they doing share buybacks? Let's see. They've bought back 3% of the entire company in the past year. Man, Trane Technologies is a great company. I can see why they're doing so great. They're also on my watch list. Well, thank you, TikTok. It said live inactivity detected. Okay, we're back. Hey, thanks again, Looney, for the $2 super chat. Yo, shout out. If you want to support me, best way to support me, just go over to the YouTube stream. For everyone on the TikTok stream, I sell nothing. I have no course, book, Discord, none of that. So here's Netflix stock. This is a great company to own. The only thing preventing me from buying this stock is the high valuation. So is the buyback the net common stock? It's the net common stock issuance. It should be negative there, Ace. So here is Netflix, though. This stock is incredible. We can see their premium subscribers. They now have over 300 million premium subscribers. That's up from 260 million the same time last year. And this is the cool part. Their ARPU, their average monthly revenue per paying membership, they're making $11.69 per user per month. And they've had incredible margin expansion and pricing power with their raising their prices. So the sales are up by 15. Sales are up by 15, but the profits, the net income is up by 45. So Netflix has grown their margin by 25% year over year. They have incredible margins on Netflix. I mean, they're a subscription model company. I love subscription model companies. They have 300 mil paying subscribers. I mean, who doesn't use Netflix? So yeah, the only thing preventing me from owning them is the high valuation. Eric said, we need a core weave analysis. Let's do it, man. And yo, Looney, thanks for the joining membership on YouTube, dude. Looney, I really appreciate you, man. So, oh yeah, let's look at CoreWeave. Then we'll pull up Duolingo right here. Yeah, I did change my profile picture, by the way. Yeah. We need the CoreWeave analysis. Let's do it. So if we go to the Nvidia portfolio right here, their largest holding is actually CoreWeave. And CoreWeave, I think just the largest shareholder is Nvidia. So let's see how they're doing. One thing I really liked about CoreWeave was how growthy the sales have been. Yeah, so they did just IPO, so there's not too much history, but what we can see is that the sales, same time last year, were 395 mil. Now this quarter, it's 1.21 billion, an over 3x increase. So the sales are growing like crazy. Bad news is they're losing a bunch of money right now. They're losing a couple hundred mil of net income a quarter. The sales are expected to literally go to 1.8 billion. That's ridiculous. So I love how growthy they are. Nvidia owns them. One stock that I found is like a cheaper CoreWeave play is actually IREN. They pretty much do exactly what CoreWeave does. So this one's at all-time highs, though. I think they're just fundamentally better. But CoreWeave's interesting. I still like them, though. You said it should. Yeah, hey, Ace, it should be negative if they buy back their own stock. Or the money should be. All right, yeah. So here, Ace, I'll do this for you. You know what? Let's go to Google. Let's pull up Google right here. So here's how you can see if this company is buying back their own stock. And Google has the second largest buyback program of any company on the planet. So here's the net income Google's making. You know, Google makes so much net income that regulators just won't, or they're too big that regulators won't allow Google to buy another company. So what does Google do with 28 billion of net income this quarter? Well, you go to the cash flow statement and you can see the net common stock issuance. You want this to be negative. It's negative 13.6 billion. That means they've bought back 13.6 billion worth of their own stock. If this number was positive, that means they've diluted you by however much that is. And here's how another way you can see if the company's bought back their own stock. We could see the net income is up by 19.38. The EPS should always be exactly the same as this growth number, should also be 19.38. But the share part of the ratio went down. So that means there's the growth is higher. So you actually own about 3-4% more of Google than you did a year ago. Anyway, that's kind of the thing about buybacks. I love companies that are buying back their own shares. They're just shareholder-friendly company. You get a 0.4% dividend yield on Google. So, and Google's trading at 22 times net income. Whenever they buy back their own shares, it makes the PE, makes their multiple go down, and makes the dividend cost less and gives you more ownership in the company. So specifically, if you notice about any one of my stocks, every single one of these stocks, every single one of these on here buys back their own stock like crazy. That's one thing I very much look for in a stock, to see if they buy back their own shares. And every single one of these stocks in here are buying back their own shares ridiculously. I do have some that don't do that, like some smaller names that don't need to be in the position to buy back their own shares. But yeah, like some of these stocks are diluting you like crazy, but I still own them nonetheless because of how small they are, and it still makes the EPS go up. Like DCTH, you've been diluted by 13% year over year, but in my opinion, it's okay. Oh yeah, what platform is it? Yeah, hey US, what's up, dude? Yeah, hey, let me pull it up in the chat here. Yeah, hey, I'm on a brokerage right here where you buy stocks and stuff. It's in the link tree in my bio, the very first link there. Thanks, Looney. Thank you for the education. Yo, thank you, Vance, for showing up. What's up, Ed Music? How's it going? Yeah, hope y'all are having a good Saturday. So let's keep going here. Do you think Meta will do a stock split? Let's look at Meta too. Meta, I'll be quick about this one because I do own them, but they're just such a great company to also just never sell. They're trading at 26 times net income. That's why I feel Meta could go up to $800 plus easily, because that would just put them up to like a 28 PE, which is pretty fair for a Mag 7 company. They have crazy daily active users. They have 3.48 billion daily active users. They own Instagram, Facebook, WhatsApp. They actually just introduced ads to WhatsApp after the original founder's slogan was no games, no gimmicks, no ads ever. And now it's here. But they print money. This is an advertising company, 40% net margins, $2 trillion market cap. Net income's up 36% year over year. They also have so much leftover money that they're doing share buybacks, and Meta now pays a dividend, which is pretty cool. So another company to just never sell. They also just signed they own the Ray-Bans. I love the Meta Ray-Bans company, but they signed a $10 billion cloud deal with Google. They bought a stake in Eswar Luxottica, whatever that's pronounced. That's the parent company for Ray-Bans. So yeah, if you heard of those Meta Ray-Bans, Meta stock just bought like 4% of that company just because they're working with them so much. So if you own Meta stock, you own some Ray-Bans. When do you sell your stocks? When I don't like them anymore, or if I don't like their financials. Like if you look at all these stocks in here, every stock that you see right here, I've never taken a single dime of profit on. I've never sold any stock I've bought in here. Like Powell Industries, I'm up 300 or 236%. I haven't even trimmed a single share. Cover Systems, I haven't trimmed a single share. I'm up at 92%. That's because they're still reasonably valued even at all-time highs. Same with Powell Industries and some of these other companies. So sometimes it's not just like when I saw SoFi. When I first sold SoFi, I was up 200% on SoFi. I sold most of my position. When I was up 300% on Robinhood, I sold most of my position. Seemed right at the time to sell it, but it wasn't. Sometimes you don't always want to sell your winners. Don't sell your winners. What do they say? Don't trim your flowers and then plant some weeds. What up, Lucas? He says SYK seems like a good company. Let's check it out. SYK stock. So Stryker Corp. I don't think I've heard of this one before. Let's check them out though. So they're at near all-time highs. So yeah, congrats if you own this one. They're huge. $149 billion company. So it's a huge market cap. MedSurg and Neurotechnology. So they're in the healthcare industry. This business is up 17% year over year. That's good. And orthopedics, that's 40% of the revenue. Let's just check out the bottom line here, though. So revenue is up by 11%. And look at that net income. They're making, let's go to operating profit. They're pretty much making 5 to 6, 700 million in net income every quarter. Really good profits on this company. A nice yield as well, a near 1% dividend yield. They're not too bad. And it looks like the analysts are expecting the revenue to pop up as well, go to over 7 billion. Same with, look at these EPS numbers. They've constantly been missing on net income. So they're actually having, when we looked at their operating profit, they're actually having some weird one-time adjustments. So the PE, this net income multiple is actually lower than a 51. It's probably like a 43, but EPS is expected to nearly double next year in some quarters. Pretty cool. All right. Oh, dude. Yeah, H, I'm so sorry. I keep saying Duolingo and then I keep forgetting. Look at SATS, crazy deal they just bought. Hey, Roscoe, say that one again so I don't forget it. I want to look at that one next. So here's Duolingo. This is that boring language learning app. So they reported incredible numbers, but on basically the same day, the next day, ChatGPT and I think Google as well. I don't know if Google the same day, but released like an updated version of their competitor. So they're having some competition from OpenAI or something. I don't know. But for right now, this business, not financial advice, is a buy. It's worth nibbling at under $300 a share. I wouldn't make it as a huge meaningful position yet, but I definitely put this one on the watch list, not financial advice. They're so growthy. 83% of the revenue comes from their, I might have to reset the app here. But comes from their subscription revenue in the subscription business. Like these year-over-year growth rates in the middle are absolutely ridiculous. It's growing 50% every year, every quarter. So the subscription revenue is up 46% year over year. The advertising revenue, because there's ads on their platform, is up 55%. Every metric is growing like crazy. They beat on every metric by a huge margin. They beat on revenue. They beat on net income by nearly double. They beat on EBITDA by like 80%. They have incredible margins, 72% gross margins, and they're having net margin expansion. Sales are up 41, but net income's up 83. That means they're expanding margins, and they just deleverage your balance sheet completely with no net debt anymore. So if you're wondering why did the assets go down, the assets went down with the liabilities. So this is completely okay. So you really would look at the ratio here, the 36% ratio, and things look great. So they have $1.1 billion of cash. And I'm not seeing the debt. You know what? Oh, well, then, yeah. I think they're debt-free. Okay. Anyway, Duolingo's great. I think they're a good never sell. Is Amazon a buy? Yo, I do think so. But not tremendously at this price right here. Amazon's just a forever hold stock. Every time I see it on a dip, like I bought one share here, I kind of just, the way you always like, find a good deal on a stock, like you just have the cash on hand, and then whenever you feel like I've been watching Amazon for the past couple of days, it's selling off more than it would, so I'll just buy an extra share. So I didn't that's how these look so perfectly timed, but you just kind of feel that way. Here's what I love about Amazon is like a never sell company. I mean, did you know the most valuable part of Amazon, which brings the most to their net income and it's most of their market cap, is actually the AWS business, the Amazon Web Services. It's over $100 billion of annual revenue for them. A lot of people know, actually, if I zoom out here, wait, I wonder if it'll show here. So yeah, a lot of people know Amazon for their online store, their website. That's only 40% of the business. Then they have the third-party seller services. Then the AWS. Then they're, the subscription revenue from the Prime. They're an advertising company. Amazon's cool. They also are a net margin expansion story. Medical supplies, hip knee replacements. Oh, cool, Van Paths. Huge profit. I used to work for Zimmer. Hey, is Zimmer a stock right there? Is they publicly traded? So someone said a very unfortunate company that I would heavily stay away from. This is IEP. I actually used to own this stock right here in 2022, like around this time right here. But this is an MLP. So first off, if you buy this stock right here, it's technically not a stock. You're buying a unit. You're a partner in the company. So you'll get a K1 tax form. So first off, you don't want that. They're notoriously hard to fill out. You get a 30% dividend yield, but they keep on cutting their dividend. They can't afford the dividend at all right now. So if you look at their net income, they're losing net income every quarter. So they legit cannot afford the dividend, and they've also been diluting you like crazy. I wonder if we can see that if we go down here. Net common stock issuance. Oh, it's not going to show. But if you go to the Carl Icahn, let's see if we go to shareholders. Carl Icahn owns 86% of the business. Anyway, I don't buy that one. Not financial advice. Thoughts on NVO. So yeah, this is that weight loss prescription company. If you've heard of Ozempic, Elon Musk is on Ozempic. It's like that weight loss injection. They also own Wegovy. So this is the main weight loss play because 93% of all of this company's revenue comes from their obesity care products. So yeah, it's a weight loss prescription play. And they just print money for now. $4 billion this quarter. They're pretty much making $4 billion in net income a quarter. They have a 3.2% dividend yield. But one thing that's really been weighing on their stock price recently is the patent expiration of Ozempic. It actually expires in a couple years. And I think that was somewhat being priced in, but I think it's overdone, and I think it is already priced in. So I'd put this one on the watch list. You're trading at a dog cheap PE, 14 times net income. Industry averages of 22. Uh, that's just because of the future uncertainty. They also did miss on their most recent earnings report. They missed on net income and EBITDA by a bit, but still, they're expected to go to a record net income in 2 quarters, like 4.4 bill plus. And they have like a 3% dividend too. ZIMH, let's check it out. So ZIMH, I actually can't find that company. Yeah, unfortunately, that one I cannot find. Ooh, someone said BULL. This is Webull. Hey, I actually used their app right here. So you're welcome. I've given them a lot of transaction fees, I bet. So in commissions, but check this out. Here's their stock. They reported earnings on Friday. They fell 7.4%. Let me see. Oh, so there's no analyst coverage right now. What were their earnings? So the sales were great actually. So sales were up by 45%. That's the good news. That's actually the one thing that impresses me. They also just literally a week or two ago released crypto trading assets again, so you can trade crypto on there. Remember, they removed it. It was very weird and it annoyed me. But they lost net income this quarter. They made net income the past 2 quarters. We do want to see them consistently make some net income. Like a lot of these other brokerages, Robinhood, Moomoo, Interactive Brokers, they print like 40% net margins. They print money. But the sales growth is amazing. And, Robinhood, when they first IPO'd as well, had these same net income losses. So it's no big deal. I think Webull's worth putting on the watch list. They could be the next Robinhood or something. Who knows? Change to ZBH. Let's see. ZBH. So Zimmer Biomet Holdings. Let's check it out. Someone in the chat, Van used to work for this company. So a $21 billion company. The stock is not doing too good. So good thing you don't work there. I guess good thing they didn't give you any stock options because the stock is the same price that it was back in 2014. So the stock's been struggling for a while. You get a 1% dividend yield, not too bad, low payout ratio. So they sell knees. That's funny. I don't like knee pads or something. I don't know. Then they're in sports medicine and extremities. That business is up nice, up 17% year over year. It's hips. So he said medical supplies, hip knee replacements. Okay, so hip and knee replacements is what this company does. Pretty interesting. Let's check out the profits here and the sales. So the sales are up by single digits. Sales are up by 7. Net income fell by 40. So that's kind of the bad news here. They're actually losing their margins. So the margins fell by 40% year over year. So that might be what's hurting the stock price right now. The cash flow numbers look good though. Yeah, the free cash flow looks great here. So they're making a couple of, they look like a value play at 25 PE. Robinhood app is not good at all. Hey, what up, Daisy? The Robinhood, that's why I'm not on Robinhood right now. I do have a Robinhood portfolio, but it's very simple and it's great at what it does, but it doesn't have the useful analysis tools like this app does. Oh yeah, let's look at SATS. I wanted to look at this company. I saw some people putting that one in the chat. I've never heard of it. Echo Star. Okay, so they rallied on this day right here. Was there any specific? There must have been some sort of news. AT&T acquires 23 Echo Star. Maybe they got acquired or something. I don't know. So they're in pay TV. So yeah, this is kind of a business that cable TV should just decline single digits every year from now on. It's down 8% year over year. Wireless revenue, hey, that's up 5%. Broadband satellite, that's down by 14%. So looks like there was some huge acquisition, I'm assuming, because before today, this really isn't a business that I would buy or try to make a play on because it just sales are down 5 after being down 9. Net income they're losing net income every quarter. So I'd be careful with SATS. Fahim said, is this pre-recorded? This is not pre-recorded. It's 5:03 at the top if you can see that. And if you wanted to follow button, we go live every single day. And someone said, do you have classes that teach this? No. By the way, I sell nothing. I have no course, book, Discord, WhatsApp, Telegram. I teach nothing. I sell nothing. Watch out for people impersonating me. I'll never follow you or DM you. Is my only account. Or the only other thing I do have is a YouTube channel. Actually, the number one way to support me is just subscribe to my YouTube channel. I'm streaming on there as well. If you miss anything, you can replay it on the stream. But let's keep going here. Can you analyze ULTY? So a lot of people have recently been talking about these covered call ETFs. So if we look at the dividend yield on this company right here, it's almost unbelievable. A 130% dividend yield. But this is a covered call ETF, and it doesn't really total return outperform. You know, when you add the yield you get every year plus how much you've lost in stock price, you're like still your total return negative, which is unfortunate. So you're basically, I'm not trying to hate on this though, but basically you buy it to maximize your dividend income. The asset is going to continue to perform like this just from their nature of selling calls. So I'm not, and the only reason the yield is so high, the yield actually isn't 120%. Whenever the stock price goes down, it makes the yield go up, and the future payouts are actually going down on this ETF. So I would just be careful with those covered call ETFs. But T only did a deal. Hey, nice. Looney says, is MMM a hold? So yeah, 3M right here. They're a pretty cool company. You know, they have the Velcro. They invented Velcro. They own Post-it notes. So they had some lawsuits over here. They gave these earplugs to the military that unfortunately gave them a disease. Yeah, they sell safety and industrial equipment. That business is up 3.5%. Transportation is down year over year, 0.5%. So one thing about 3M is it's kind of, it's boring. And it's not growing too much, or barely at all. So the sales are up by 1.4% year over year, barely beats inflation. But good news, they're making a lot of money. They're making, just around 800 mil to $1 billion of net income. Hey, my YouTube is called Nathan Robert. It's also in the link tree in my bio. Thanks so much, Sir Peanut. I appreciate you. Yeah, we'll look at APLD too. But good news is this company's making a couple $100 million net income a quarter. They've bought back 3% of all the shares that exist, and you still get the 2% dividends. You get a 2% yield, 3% buyback yield. You have like a 6% total shareholder return. But again, I think they're a little too boring for me. That 1% sales growth wasn't really blowing me away. So here's a company actually owned by Nvidia. This is a pretty cool stock, actually. So if you go to the Nvidia portfolio, their third largest holding is in APLD. And APLD just had a huge partnership with CoreWeave. So that's really why they rallied on this day right here. And then they just continued that rally on earnings after they affirmed the guidance. So if you look at the actual revenue expectations, it's like they missed on their numbers, but it's expected to. Anyway, this one's owned by Nvidia. I'd be careful with this one though, but I do like them. Okay, hey, Pancho, what's up, dude? Yeah, hey, I'm on a brokerage right here. If you want to get this app, it's in the link tree in my bio, that very first link there. So Meek said Circle. You know what? And you know who owns Circle is actually Kathy Wood. So if you go to the Kathy Wood portfolio, it's lower than 3% of her portfolio. So Kathy Wood does own Circle, but let me just pull it up over here. We'll pull up Circle. So this is the company that owns USDC. So have you heard of that stable coin? USDC, this is like the issuer for that. So whenever there's stablecoin regulations, like when the Genius Act passed, this stock rocketed. So let's see, they lost net income this quarter, but I believe I remember reading some, this was their IPO like one-time expense thing. So because normally they're actually making net income every quarter, they're super growthy. Look at the sales, 94. It's at 658 million, a new record this quarter. So actually, I really like Circle. I'm going to actually re-put them to the top of my watch list to potentially maybe buy them. 30 bill market cap. I probably want to wait a little bit more. Hey, what up, Snake? Thanks for subscribing, man. I really appreciate that. So here's Dutch Bros. This is like that Starbucks competitor. Yeah, it is. Here is Dutch Bros right here. Here's what I like about this stock. If you go to their company-operated shops for For a restaurant in this environment to grow, 29% year over year to a new record, I think it's just really impressive. So the company operated shops are up 29. They also have their franchising revenue, high margin franchise fees. That business grew 20% year over year, also to a new record. So Dutch Bros is just growing and they're keeping their margins. One huge thing with Starbucks stock, which is the reason they're flat on 5 years ago, is the margins are collapsing on Starbucks. But this company is actually growing their margins. So they actually have like a 3x higher margin than Starbucks does in the most recent quarter, though way, way, way smaller numbers. But yes, Dutch Bros is looking pretty good. I can see why they're doing so good. I suppose with dividends, you just need to pick the amount and invest in the payout you want. Hey, what up, Grug? What's up, man? You think 130 is the bottom? I'm not sure. Your thoughts on HE recovering from the fire? So yeah, this is Hawaii Electric. If anyone remembers those like Maui or Hawaii wildfires, this is and this was in 2023. So you kind of got to think back. Wow, there were these huge wildfires where people were putting up blue tarps everywhere over their houses. This company was blamed for all the fires, and they got fined more money than their entire market cap. Actually, let's see if we go to their fines right here. Yeah, so they had to pay basically it was a $2 billion fine in total they had to pay. And if we look at the whole value of the company, they're only a $2.24 billion company today. So it was a tough fine to pay. The one reason the sales are down so much is because they sold off their bank business, which is unfortunate. Like, look, their electric utility is 99% of the revenue. If we go like to 2024, what was it? Yeah, the bank business used to be it was like 10% of the business. They own like all of Hawaii's banks. It was pretty cool, but they sold off their bank business to pay down some of these fines. But luckily, they are making net income now. I would still be careful with Hawaii Electric, but I'd be careful with them. I like other utility players more. Good afternoon. Hey, what up, Mo? Good to see you, man. So, SiriusXM, dang near every car has it. So, actually, a lot of people don't. Like me personally, I don't use the radio. I connect my phone. I load up. We're seeing a lot of people just use their Apple Play, their phone to their car. So here's the thing about SiriusXM. And what's up? Yeah, hey David, right here. If you want to get this, it's in the link tree in my bio. If you want to get this app, I'm on. It's the very first link there. But here's SiriusXM. The stock's at an all-time low. Warren Buffett does own a lot of this stock. Like if you go to the largest shareholder, Warren Buffett or Berkshire Hathaway, which is Warren Buffett's company, owns 37% of the shares. So Warren Buffett owns a lot of this business, but they're kind of just like a dying business. They're going to slowly bleed out. Like the sales are down 2% after being down 3%. Like their revenue comes from, SiriusXM. If anyone's heard of SiriusXM, look at that. The business just really isn't growing. So, but one thing you do get with this company, this is the only thing that kind of saves the business here. They make around they had a one-time, if we go to their net income right here, it says they lost $3 billion. That was a one-time adjustment. Still not great, but this company makes $300 million in net income a quarter. Let's see what the dividend cost. The dividend only costs $92 million in net income a quarter. So this company has for right now, a sustainable 4.55% dividend yield. So you get a really nice 5% yield, but the sales aren't really growing on SiriusXM. Okay. What up, Eyes? eToro. What's the ticker symbol for eToro? Hey, what up, Mikey? He said PSEC. PSEC. Yeah, hey, this is a BDC. So this is a business development company. They do loans, and they have a rule, or by SEC law, they have to pay out 90% of their taxable income in the form of a dividend. And so that's why when we go to the dividend, it says they have a 20% dividend yield. But here's the thing: these BDCs, I own a company that does the exact same thing as Prospect Capital. There another BDC is Main Street Capital. This is the one I chose over them because I've looked at them before. I actually used to own PSEC at one point, and multiple years ago. And now I own Main Street Capital. So this one I think has an unsustainable dividend. They had to cut it last year when Main Street Capital is doing special dividends because look at these net income losses. So I think, in my opinion, it's just hard to trust PSEC. like in the past 4 quarters, all they've done is lose a bunch of money. And if we look at the revenue, yeah, look at that. The sales are down 21% year over year. So that's the thing. That's why I think PSCC has struggled so much. And I think they might continue to bleed out, but I'd be very careful. Step down says, can we see your holdings? Yeah. Hey, by the way, if you want to see every stock that I own, you can go to my YouTube channel. I do stock portfolio updates all the time. I have multiple portfolios here. Like I have different goals with each portfolio. This is my dividend only portfolio. Every stock in there pays a dividend. This one right here is my buy and never sell account. So once I buy a stock in there, I try to never sell it. Then over here, I have my risk on growthy account with like Reddit, SoFi, Robinhood, AMD. It was super micro. And as much as I love those names, I keep them as very, very small positions. And a lot of those stocks that I own in there, I would never touch at today's valuations. Okay. Sergi, what up? He said TTD, the trade desk. This is that TV advertising company. And oh yeah, we'll look at ETOR after this. Remind me to look at ETOR. Yeah, Maine is great. Yeah, Mike. Yeah, I love them. So here's the trade desk right here. There's kind of a few different things of bad news here. I think, to be honest with you, I think this one's going to go under 50. So I'm waiting to buy the dip on this one. I'm putting them on my watch list, but I wouldn't. I'd maybe buy here as a very, very, very small position, but I wouldn't do any meaningful buying yet on this company because there's a little bit of bad news. The Roku, Amazon is like coming for their market share. They just lost Netflix as a partner. Netflix ad tier used to use the trade desk to find advertisers, and their margins are falling a bit too. And they just gave guidance for single-digit revenue growth, which investors don't love single-digit growth, but the sales were up 19, but the net income was only up by 6%. So that means the margins fell by 10 or 11% year over year, which wasn't great. So I can see why this one fell because even after their little fall here, they're still trading at 65 times net income. So for those reasons, I think the trade desk might go under 50, probably back to this $42, $45 level. That's where I'll consider trade desk, but they're on my watch list. They're still making net income every quarter. I love their TV ad business, but I'd wait a little more. What's the YouTube channel? Yeah, hey, Step Down. Thanks so much. Yeah, hey, my YouTube channel is called Nathan Robert. My YouTube channel is also in the link tree in my bio. You can just type in YouTube Nathan Robert. I'm also streaming on there. That's the best way to support me. Just watch the stream from YouTube. My YouTube channel's I'm streaming on there as well, and you can replay it after it's over. The very beginning of the streams are really fun. So here, someone said eToro Group. I haven't heard of this one before. It looks like they IPO'd just about 6 months ago. They're a $3.7 billion company, and they're in trading activity. So this might be a brokerage. And look at their annual sales there. That's really impressive. It's spiked up to a new record. That's super impressive. But it looks like all the revenue comes from Israel. So this is not a U.S. company. So do keep that in mind. That might be one thing. They're based in Israel. That's where they're headquartered. So. And all the revenue comes from Israel. So do know that when you buy this company. And they just IPO'd. They didn't have too much history, so I do apologize. I wish I could give you more thoughts on them. So David said ET in stock. AC, what's up? Can you make DUO, please? Yeah, we'll look at DUO, Capital One Financial, DTSS, Disney. What up, Art? Yeah, we can look at Disney too. So, hey, what up, Chris? Appreciate you, man. Yeah, hey, best way to support me, hit the like button, hit the subscribe button. We stream every day. Sundays are the best streams. Tomorrow, I'm going to be doing 2 streams tomorrow. They're usually the most popular. But here's Eaton. This is a huge, I think they might have an aerospace business, but this is a huge energy play, electric infrastructure play. And I wish I owned this one. Actually, instead of buying Eaton, I bought Powell Industries. And Powell Industries has done better, but I still love Eaton. Yeah, look at this. They're in aerospace. Their 15% of the revenue comes from aerospace, and it's growing very nicely. Double digits. It's now $1 billion of revenue for them, over their first ever $1 billion revenue quarter for their aerospace business. And the net income is very strong here. I mean, pretty much $1 billion of net income every single quarter. So Eaton, I really do like this name. I think it's one you just want to never sell. You get a 1% plus yield as well. Is Main Street Capital better than O? They're very different. I think Main Street Capital will probably return more than Realty Income, but it maybe not by much. So DTSS stock. Yeah, of course. What up, Celerate? So he said Data C. So actually, we're not going to cover this company. We don't really cover these kind of stocks. If you look in the top right, the whole company is worth $15 million. So, and they're losing millions every quarter. the sales were decent, but I be super, super careful with that $15 million market cap. So let's look at DUO now. Yeah, sorry, I try to get to all the stocks here, and I do try and go pretty quick out of respect for everyone. So yeah, this is another company that I wouldn't really touch. I mean, they're worth $9 million. The stock's at an all-time low. They're Chinese as well, so we have to convert the revenue to USD. You'll have to pay some ADR fees. So, and they're the revenue list. This is from 2022, so it's a revenue list startup. Don't buy that. Hey, what's up, AC? Be super careful. I wouldn't even like consider that one, to just being honest with you. So here's a company I would consider though, but not as a meaningful position. I do own this one, by the way. Actually, let me show you where I own this stock. I own it in this account right here. And this isn't normally the kind of stock I own. And yo, step down. Thanks so much for the rose there. I really appreciate you, man. So Disney is the exact same stock price that it was back in the year 2015. So for a decade, Disney has done nothing. But I still own them because they finally gotten their streaming services extremely profitable. If you don't know, they own ESPN, they own Hulu. They just bought the remaining stake of Hulu from Comcast, so now they fully own Hulu. They just got MLB rights, NFL rights. So Disney's streaming services are doing great. The parks business are seeing a recovery. They're opening a new park in Abu Dhabi. So I think this one, I think Disney is going to underperform the S&P 500, but it'll still be a nice, I think Disney will return like 6% a year from now on, or like 6-7% a year. Not market beating like the QQQ or S&P, but that's why I own them. I just like, I like them. I pay for Disney Plus. Why not pay for the stock too? But invest in what you use. Like you watch YouTube, buy YouTube stock via Google. You're on Instagram and Facebook, buy some Meta stock or McDonald's. I love McDonald's, or my standards are pretty low, but buy some McDonald's stock as well. Okay, what up, Francis? What's up? How do you learn to analyze these? Yeah, hey, I've just been looking at stocks for a long time. I've been investing since the day I turned 18. I've done well only investing in American companies. Yeah, I only own one non-American company. The only one non-American company I own is FUTU. It's the only Chinese stock that I own, and I love them. Great financials. So what up? Tyman said, can we look at KBC stock? Let's do it. So this is an Australian company, so I don't think you're talking about this one either. Unfortunately, I can't find that market cap. I do apologize there. If you got another stock you're going to look at, let me know, though. I tried to find that one. Okay, yeah, KBC or ING. Wait, in and out. Let me know if you're talking. Wait, KBC stock. Yeah, I can't find KBC. Okay, let's keep going here. What's your thoughts on UPS? Yo, what up, Simon? What's up? So here's how we can tell if a company has an unsustainable dividend. So if we look at UPS stock and we look at their dividend, they have a 7.5% dividend. The goal with the market, if you buy the S&P 500, the hope is to get like 8% a year on average. And this company's basically saying you'll get nearly an 8% yearly return just in cash from a dividend a year. Here's the thing about that, and I think the market is, kind of priced this in, that the dividend isn't too sustainable as we once thought. It's because of this right here. So they actually couldn't afford the dividend the past 2 quarters. They made $1.28 billion of net income this quarter, a little less than that last quarter. But remember, they made $1.28 billion, and the dividend every single quarter, where'd it go? It cost $1.35 billion. So this company needs to, at very least, make $1.35 billion of net income, or else, the dividend payout ratio is over 100% of the net income. They have no leftover money. So they need a healthy dividend cut. They're still making a bunch of net income, but over 100% of it is basically being eaten up by the dividend. Futu, yeah, is great. I agree. ONDS stock. And Kava. Hey, Kava, this is another kind of restaurant. They're kind of like a Chipotle competitor. I just saw one for the first time next to this Best Buy I was at. Let me see what their earnings were. So they did gap down on earnings because it looks like they missed on revenue, beat on net income, and beat on EBIT. But it looks like the sales missed, but sales still grew by 20%. And net income grew by 26%. They might be a little oversold. What's the valuation? Oh, so it might just be, they didn't meet the revenue expectation, and they have such a high multiple that it had to fall back to reality. So they're trading at 57 times net income, which is still might be a little high. They're still interesting though. I actually, honestly, I'd probably rather feel safer buying Chipotle on the dip. They might just be following Chipotle, but Chipotle is another really cool stock. $56 billion company trading at a lower net income multiple than them, but obviously they're in different stages. So ONDS stock. What is ONDS? Oh, I think this is Ondas Autonomous Driving Company. So I think they have a huge. Is it a partnership with? Oh, well, here's one. Ondas partners with SafePro for AI drone threat detection. Ondas acquires a 51 stake in SPO. So they're doing some investments. Pretty cool. What's the market? Again, very small. I'm not touching this one, but it's a $1.6 billion market cap. And yeah, Ondas Autonomous Systems. I think this might be a car or a drone thing. I'm not sure, but we can see the revenue is expected to, go from 4 mil to 9 million. So the revenue is expected to just double and keep on climbing to a new record, but it's still very small revenue. It'll probably be actually 40 million a year. They won't really make any profits on that. They're losing a bit of money, but they just fortified their balance sheet by issuing some shares. Anyway, that's a small cap kind of momentum play. I'd be careful with them. All right, so KHC, does TM stock do any buybacks? Toyota Motor said, this is a Japanese company. 250 billion dollar company. So we'll convert their currency to USD. Here's how we can tell if they do any share buybacks. You look and see, they've bought back 2.5% of the shares. You can see the net income is down by 28. But the net income per share is only down by 26. So that means there's 2% less shares than the year before. It means you own 2% more of the company. Another way you can check if they do share buybacks is just go to the cash flow statement. Then you go to the issuement, retirement of, they're a Japanese company, so it might not. Oh, here it is. Yeah. Here's the money they're spending on buybacks. They spent 300 mil this quarter, 900 mil last quarter, 900 mil last quarter, 6 billion this quarter. So they're buying back a lot of their own stock, and can they afford it? Yeah, they can. They made $6 billion of net income this quarter, $5 billion last quarter, $14 billion the quarter before. So that's Toyota Motor. That's so you can check if they're doing buybacks. So food is fire. Hey, Secular said KHC. So that's just, you know what? Let me go to Warren Buffett's portfolio for you. So if we go to the Buffett portfolio right here, one of his holdings are KHC Kraft Heinz. They're like that ketchup. They own Kraft mac and cheese. They own Lunchables. They own Capri Sun, some kind of brands like that. And this stock has not done too great. Same price as they were back in 2019. They have they're mainly a dividend play. Check that out. You get a 5.7% yield on this company. Let me see the actual operating profit. So yeah, you want to look at the operating profit and not the net income. They just had this one-time adjustment quarter, because if they really lost $8 billion in net income, that would not be good. But they're pretty much making, when you take out the tax after this, they're pretty much making around 900 million in net income a quarter. Let me see how much their 5.6% dividend yield cost. It only cost $474 million. So the dividend is safe, but this isn't a real company that I think will outperform the market in the long run. They do have a lot of debt. The original investors just kind of ruined the company by making them have such a high dividend and milking the dividend a long time ago. But they're interesting. I don't really think they'll outperform the market in the long run, though. A stock that I like more might be General Mills at this price right here. I think this one's a bit of a safer play, because look at General Mills, specifically how diversified that they are. This is what's so cool about General Mills. They're in snacks, cereal, convenient meals, pet industry, dough. Yeah, they own Pillsbury dough, yogurt, super premium ice cream. I wonder what brand they own, like Ben & Jerry's or something. I don't know. But anyway, that's General Mills GIS. Let's keep going here. I'm deep in CMG. Oh, hey, what up, Fish? Hey, nice. It's drone. Hey, that's cool. So here's another kind of dividend play. This is PFE. Let's do it, Looney. So this is Pfizer stock. So it doesn't make sense to pay dividends unless they're putting them. So yeah, some of these, I heard the argument that if they're paying dividends, they can't really innovate anymore. That's not like Google, for example, Google's just too big to like buy a company with leftover cash. So they just return it to shareholders. What app am I? Yeah, hey, again, I'm on a brokerage right here. It's in the link tree in my bio, the very first link there if you want to get this app I'm on. It's an affiliate link, full disclosure. Or you can just type it in Google. It's just a brokerage called Moomoo, but link tree in my bio. Are you doing all this from your phone? Yeah, on my phone. Yeah, hey, sorry if I'm going really fast here. By the way, if you missed anything, Ace, or want to replay the stream, I'm streaming on YouTube as well. You can kind of rewind it. But let's get to Pfizer right here. Sorry. If we look at their dividend, you get a 6.9% dividend. That's a pretty high yield. The payout ratio says 120%, but that's based off the last full year. Their dividend is now sustainable again, so the payout ratio is realistically around probably 75 to 80%. Here's how we can tell if they can afford the dividend. So the past 2 quarters, they made 2.93, 2.9. So they're making 2.95 billion in net income a quarter. They at least need to make 2.45 billion to afford the dividend. So the dividend every quarter costs 2.45 billion, and as we can see, the past 2 quarters they've been able to easily afford it. So we want to see them continue this trend of making this sort of net income, and analysts are completely expecting that. The next 2 quarters, it's basically expected to stay at this exact same, basically $3 billion in net income level. So they do have a couple $100 million of leftover net income to play with. So Pfizer is a nice little dividend play, but again, that one's kind of, I don't know if it'll outperform in the long run. Unfortunately, isn't this crazy? When you don't include the dividends, Pfizer is the same stock price that it was back in 1998. So, but yeah, it's like a dividend play. Yo, what up, Vandy said Grab Holdings. This is such a cool company, guys. So this is basically Uber, but for everywhere else except the United States. So this company does exactly what Uber does. Passenger rides, but look at where they get their revenue from. It's like international Uber. Notice the US and Canada aren't even on here. So none of the revenue comes from US or Canada. And that's why Uber decided to buy the company. If we go to the largest shareholder of a Grab Holdings, it's actually Uber. Uber owns 13% of all the shares. And then there's Toyota Motor. Hey, we just looked at Toyota Motor stock. Toyota Motor owns 5.5% of the shares. But anyway, that's why this company is basically backed by Uber. And it was genius for Uber to buy a stake in them because this now gives Uber instant international diversification. I'm really actually looking into buying Uber stock, but this is another one that I'd happily just buy and hold for the long run. So yeah, and it's kind of an international play. You don't really see too many companies like this. It's like a way to get out of US and Canada, UK. You get exposure to all these countries, really. No weird taxes. Are pretty cool. Grab's interesting. You believe September will bring market down? I hope not, but sometimes there are the months that do that. So, let's see. Look for Rocket. Hey, are you talking about Rocket Mortgage? Hey, thanks so much, Richard L. I appreciate you, man. So, someone said HWM. So, how much? Hey, what up, Ito? So, this is an aerospace play. And as we know, a lot of the aerospace and defense companies have been rocketing. And this one has been as well. Let's see. Engine products, fastening systems, engineered structures, forged wheels. How's the forged wheels business doing? Well, it's down year over year. Anywho, these aerospace and defense companies are having a lot of, this company specifically has had a lot of pricing power. Because if you look at their total revenue, the total revenue is up by 9%, but the profits, the net income is up by 53%. So what does that mean in English? Basically, they have incredible pricing power and net margin expansion. I mean, net margin went from a 14% to a 19.8%. That's huge when you're doing, $2 billion of revenue. Like if Coca-Cola can make an extra 1 cent of a profit per bottle, they're making millions more. So it's when you're able to expand your margin like that, bro, that's the reason they're doing so great, and as the industry. But very impressive, very impressive. Hey, what up, Happy Not? How's it going? We use them every time we go to Asia, and they're awesome, and their app's super easy to use. Oh, the Grab app, that's awesome. So let's see. I bought Oracle on Friday. Yo, where's my for actually MS stock? You know what? Actually, let me look at this one first. I apologize. Then we'll get to Oracle and MELI. Hey, that's like the international Amazon play. So here's Morgan Stanley. This is just a bank or like an asset manager too. The banks have been doing incredible. If we look at JP Morgan as well, the banks are pretty close to all-time highs, and the banks have nice dividends too. You get a 2.5% dividend. They're usually doing some share buybacks as well. Yeah, actually, look at that. Wealth management is actually half their revenue, and that business is up 15% year over year. The wealth management business is usually higher margin. What are their net margins? 20% plus. Very nice. And the net income, yeah, they're making 3-4 billion in net income every quarter. So MS is very cool and a 2.5% yield. Nice bank. So yeah, let's check this one out. I bought Oracle on Friday. And then, oh, we got to look at CNC. Hey, Looney, let me know. You want me to look at CNC or FEIM? Let me know. Here's Oracle right here. Again, a huge cloud play. On Friday, they really struggled. They were down 6% on Friday. But check this out right here. If we look at where the revenue comes from, 85% of it comes from their cloud and license business. And if we go to their actual net income down here, they're making over 3 billion of net income every single quarter. They have a really high market share as like a cloud service provider. Yeah, 3 bill plus in net income a quarter. You get a 0.8% yield. They do have a bit of debt. Like it take them like 8 to 10 years to pay off all their debt at right now's net income, but they're expected to grow their net income a bunch. That's an interesting company. So this is a triple net lease stock. This is ADC. This is Agree Realty Corp. This is a real estate company. They do triple net leases, and their top customers are literally Walmart, Kroger, Lowe's, 7-Eleven. They just own the land under it. And that's why, if we go to their dividend real quick, it's a 4.2% dividend because they're a REIT. That stands for Real Estate Investment Trust. And literally by law, 90% of the taxable income they make has to be returned to shareholders in a dividend. So that huge yield that they have is very sustainable. Another way you can check is you really want to go to the cash from operations down here. You don't look at net income for REITs because it doesn't include the depreciation and the amortization, which is very important for real estate investment trust. So you go to the cash from operations. They made 119 mil of revenue this quarter, and the dividend cost 86 million. So we do know that their dividend is safe and sustainable. I do like Agree Realty. I almost like them more than Realty Income. Actually, I do probably like them more than Realty Income. I don't get the hype around MELI. Let's check it out. MELI stock. So this is Mercado Libra or whatever. I don't know how to pronounce it, but this is like the Asian Amazon. So if we go to where the revenue comes from, actually, I was wrong about where they're from. Actually, South American. So look, 55% of the revenue comes from Brazil, and then 22% comes from Mexico. So notice the U.S. isn't on here. So basically, a pure South American Amazon play. It's like they're in commerce services, financial services, credit revenues. How's that doing? Is it gonna break it up? Yeah, the commerce revenues have been growing like crazy. So if we just go to the total revenue right here, let me see. Revenue's up 33% year over year after growing 41% from the previous year. They're continuing that growth. That's so impressive. And they're making 500 mil plus in net income a quarter. That's very good net income numbers. You know, they're probably CapEx heavy like Amazon is. Cash and investing, not bad. So anyway, MELI, I can see why people like this name. The valuation is a bit high. 61 times net income. Yeah, they're a bit expensive, but they're pretty cool. Have you ever heard of interbank delivery? Yo, what up, Chai Marie? I don't think I have heard of that stock. If you give me the ticker symbol, I can check it out for you. Mo said BBVA stock. So this is Banco Bilboa something. Okay. $100 billion market cap. So this is a huge company, European company. So we'll convert the revenue to USD. Let's see. So yeah, revenue's up by 3% year over year. So revenue's not growing too much. It's up by just, sorry. The revenue is up by, just 3% year over year, but they grew their margins a bit, and they're 30% plus net margins, and they're making a boatload of net income. And this is in USD, 3 billion plus in net income a quarter. That multiple must be pretty fair then. Yeah, 8 times net income. They're trading at 8 times net income, and they're a $104 billion company. Huh. Let me see what they do actually. So, a banking company. Okay, so it's a bank. That makes sense. So, all right. AG&C. So, unfortunately, this one I think is a dividend trap. This is actually a mortgage REIT. They do loans. And you're basically buying this for the dividend to maximize your dividend income. When we look at the yield here, you get a 15% dividend yield. But when we look at the stock price, it's not really what you want to see. Like they're down over 50% since 2019. These don't really outperform the market in the long run. But again, you mainly just buy it to maximize your dividend income. Get that monthly payment. What happens is, hey. Ooh, sorry, I'm really tired, man. I've been streaming for like 2 hours. So, hey, yeah, if you want to get this app, it's just a brokerage where you buy stocks. It's in the link tree in my bio, very first link there. It's an affiliate link, full disclosure, or you can just go to Google and type in Moomoo. But yeah, link tree in bio, first link there. I appreciate that. All right, so someone said, NET, Anthony, what's up, man? This is Cloudflare. This is one of my favorite cybersecurity names out there. They're so growthy. They're not making any money yet, but literally, this is the part that's crazy. 20% of all internet traffic, all worldwide internet traffic, goes through Cloudflare in one way or another. Huge Internet of Things business. And if we go to the revenue, it just hits a new record every year, every quarter. So if you go to their annual revenue, look at these year-over-year growth rates. I mean, 50%, then another 50% growth, 48, 30. So the growth is slowing, but the numbers are getting bigger. They're just growing incredibly fast. They're still trying to get net income positive, but Cloudflare is a great one. Valuation is a bit high right here. One that you just kind of buy it and then just never sell it. SE stock. Yeah, what up, Jimmy? He said SE stock. Let's do it. So this is another e-commerce player. I believe this one's in Asia, actually. So if we go to the market revenue, so yeah, look, 70% of this company's revenue comes from Southeast Asia, then Latin America, and rest of Asia, all those other countries. But this is kind of like an Amazon. They're an e-commerce play. That's where 71% of the revenue is. And it's growing like crazy. It's up 33%. These growth rates in the middle are just ridiculous. If you look at it on an annual basis, that's just incredible. I mean, in 2019, it was 800 mil. Now for the full year 2024, it's 12.5 billion. So super growthy. I can see why people love this one, and not just the sales that are growing, but the profits as well. They made 400 mil in net income this quarter, new record pretty much. So great. ANET when you get the chance. I caught it at $79 in April. Let's do it. So yeah, I love Arista Networks. This company deserves to be at all-time highs, I think. Oh man. I need some coffee. Okay, so here's Arista Networks. This stock is a $170 billion name. They're a huge market cap. They sell product and service, and it's so growthy. It's up 31% year over year to a new record. It's another business. Like, it's kind of reflected in their stock price. Like, if a company just continues to hit all-time highs like their stock has, you can just guess that the sales are booming. And they're also beating on every analyst expectation. Like, this orange line is what the analysts expected. They were expecting 60 cents of net income or EPS, and they reported 70 cents, a huge beat. The huge beat on revenue, a huge beat on EBITDA. So they're just so... They're just beating all analyst expectations. And also, this net income is ridiculous. $888.8 million in net income, up 33% year over year. They have a really good balance sheet as well. So Arista Networks is very nice. Sales are up 31%. This net income is ridiculous. They're pretty much going to be making like a billion of net income a quarter. Hey, thanks, U.S. Politics. I appreciate you, man. Thank you, Mo. I appreciate that. All right, so let's see here. Rich Tech Robotics. I saw that one. To be honest with you, if I'm looking for a robotics play, I don't love Rich Tech Robotics. Like, if I just want a robotics company to just buy and hold for the long run to trust, I don't love Rich Tech Robotics, but there is some decently good news. Yeah, they're partnering with Nvidia. That's one reason why a lot of people like this one. So they're partnering with Nvidia, but they don't really have anything to show right now. Because if we go to their revenue, they have no revenue. $1 million this quarter, $1 million last quarter. They're losing net income every quarter. And I don't really think they have any patents or IP or anything. So out of all the robotics companies out there, I would go with like a Symbiotic or an Amazon. I would just be careful with Rich Tech Robotics. They're really a momentum name right now. So, okay. Should we see... Honest Company, what do you think? Yeah, what up, Romsky? So this company, there's some good news and bad news about this company. They've kind of disappointed investors with the slowing growth. I think that's why the stock's been flat since, a couple years ago, since 2024, the stock's been flat. Because if we just go to the total sales right here, the lifeblood of the company, the revenue, it's only up by 0.44% year over year. So, not even 1% growth in revenue, doesn't even beat inflation. So the revenue's not growing too well. By the way, they just sell a commodity. Diapers and wipes are 70% of the revenue. But good news is that they are making net income, and they do have a lot of net cash. They have about $60 million of net cash, and the whole company is worth $440 million. So like 20% of the market cap is just their cash on hand. And it's good news to see that they're finally going to hopefully continue to make a couple million of net income every quarter. Because when you make a couple million in net income every quarter, it's pretty significant when you're only worth, a couple hundred mil. So, what up, Michael? He said JACK. So this is Jack in the Box. If we look at Wendy's stock, Papa John's, these restaurants have kind of been struggling recently. Yikes. Jack in the Box is the same price as they were back in 2005. And unfortunately, one thing that was really unfortunate for them was their Del Taco acquisition. I owned Del Taco stock before Jack in the Box bought it. And here's the unfortunate thing. The Del Taco operations have collapsed. I mean, it's down 20% year over year after falling 22% the previous year. So the Del Taco business has been struggling hard, and also not great that the actual Jack in the Box operations are down 7% as well. So if you're wondering what happened to Jack in the Box, why is the stock at all-time lows? Well, the business is not growing, and these net income numbers are so choppy. Like they made 22 mil this quarter, but they lost 140 mil last quarter and 120 mil last quarter. So when you average it out there, it's tough, and the sales are just down 10% year over year after being down 8%. So that's why I think that one's, I'd be careful buying the dip on them. We really want to see the growth come back to there. And to be honest with you, I can't remember the last time I've ever been to a Jack in the Box or a Del Taco. I just usually go to McDonald's or Taco Bell if I just want some quick, cheap fast food. All right, so Malaysia's where the U.S. was 10 years ago. Are you able to get in a store? Thank you for pointing that out. I'll definitely be investing. Oh, hey, yeah, no problem, Vans. Yeah, I try to show, I always don't get to show everything, but I try and show where they get their revenue from in terms of countries and what business they're in. So, yeah. All right, so let's see here. Let's RSG stock. RSG. So, this is a waste management competitor. So there's two main trash companies. There's Waste Management and Republic Services. Either one of them are perfect holds. The two stocks move very similarly. You get a nice 1% dividend yield on this company as well. They're not really going anywhere. You can just trust this business for the long run. Recycling and waste business operations. They also own a bunch of landfills. Yeah, that's what they're called, landfills. They own the real estate, so they have a cool real estate portfolio. But yeah, they're a trash management company. Really boring, but this is not a boring stock price return. It's usually the boring companies that make a lot of money, like self-storage or, some of these other businesses. But here is this company. Yeah, they're making 500 mil of net income a quarter. That's really good, and it's very consistent. SCA again. Oh yeah, hey, I stopped I stopped at our McDonald's better place. McDonald's got the best breakfast, man. I've started getting the McDonald's breakfast. Is like I legit think, and I've eaten both. Actually, I don't know why I'm getting into this. The McDonald's chicken biscuit is better than Chick-fil-A's. Okay, so here's CNC stock. Oh, this is like the next domino to fall after United Healthcare. So UNH stock, United Healthcare fell a bunch. They do the exact same thing. It's another Medicare, Medicaid provider. Wonder if it'll show us data. Yeah, look at that. So 60% of the revenue comes from their Medicaid business, and then Medicare is 20%. So yeah, the government has a lot of regulation on these businesses right now, and they don't really want them making any profits. And look at this. Here's the unfortunate part. The net income, 2024 Q4, it was 56 cents of net income. It's expected to go negative $1.32. So that'll be They're expected to lose about 750 million of net income that quarter. So they're going to have a full year of net income losses. So I can see why this one had an immediate tank, just like UNH did. The future's pretty uncertain, but these could be worth looking into. But I wouldn't put them as a meaningful size position, to be honest with you. Actually, I might cover McDonald's too, because you know what? I own that stock. So check this out right here. So McDonald's, this is the best really restaurant stock out there, but McDonald's really isn't a restaurant company. They're a real estate royalty company, and they're recession, I call them recession proof, but they're really recession resilient. But like in 2008, for example, you look at any stock in 2008, they collapsed, but McDonald's and Walmart were the two best performing stocks in the market because they're recession resilient. In 2008, McDonald's actually acquired a bunch of cheap land. Also, in a recession, sales at McDonald's historically go up. People stop going to Chick-fil-A and start going to McDonald's to feed their family. And if you go spend $100 at any McDonald's, $4 of it goes back to this company as a royalty. McDonald's also owns the land under every store, so they collect rent and royalties from every store. It's just a fantastic business model. That's why their gross margins are 50%. I mean, that's insane for a restaurant. You look at Wendy's, that's not the same. Like, what are the gross margins here on McDonald's? I wanted to see again. 60% gross margins and 32% net margins. What restaurant do you know brings in a 33% net margin? That's because they're a real estate royalty company. Because if we go to Wendy's, you go to Chipotle, these are single digit margin businesses. Yeah, here's Wendy's, 9% net margin. Wendy's, this is unfortunate. They didn't do their model too correctly. Wendy's stock is the same price that it was back in 2004. And they also just had to cut their dividend as well, which is unfortunate. And they have an 8.3% yield. The dividend just, I think it went from 25 cents to 14, which was healthy. They kind of needed to do that. But anyway, McDonald's is just a great company to own forever. They're recession resilient, So that's why I just bought a little bit more in McDonald's as well. With stocks being at all-time highs, if the market falls a bit, McDonald's should be somewhat insulated. And if they converted to a REIT, they'd be in the top 5 largest REITs in the world. Interest rates going down are a huge tailwind for them. They'll kind of go up with the US 20-year Treasury bond. Okay, Wendy's has a deal in the morning for $1. Really? I didn't know that. What I've been doing, sorry, but if people don't care, on the McDonald's app, you can redeem this every morning for $4 with tax. It's $4.22 here. For $4, you get a small Coke or a small coffee, a hash brown, and a chicken biscuit. Or instead of a chicken biscuit, you can get a McGriddle or an Egg McMuffin. For $4, you can redeem it every single day. And I've been, as a broke college student, but I've been doing that every day. So, I get the good deals so I can invest all the money in stocks. Anyway, let's keep going here. Someone said thoughts on TTWO. Yeah, or politics. What's up, dude? So this is the company that owns Rockstar Games. So if you've heard of, we'll look at Loco after this. LOCO stock. Let's do it, Roscoe. How's it going? Happy Saturday, everyone. So this is Take-Two Interactive. This is the company that owns Rockstar Games. So if you've heard of GTA 5, Red Dead Redemption, this is the company that owns it. I think they own The Sims as well, some other games, but mainly the main reason the stock has appreciated so much is in anticipation of the huge revenues they're going to receive from GTA 6. It's supposed to be one of the biggest games of all time. I will say the market kind of knows this already. So I don't know how that's a thing. I think there's not crazy amount of upside. It might be a buy the rumor, sell the news thing, but basically they're going to have a huge, insane amount of revenue come in from the future from GTA 6, and they're going to make a boatload of money off that. They could have like some permanent subscription revenues from it. So I think Take-Two is an interesting company, but I do wonder how much, because they're at all-time highs right now with the financials not looking too great. I wonder how much that's being priced in right now. But yeah, they own GTA 6. That's supposed to make a lot of money. Let's look at LOCO stock. I've been seeing this one. El Polo Loco. So pretty small one, a $300 million company. They've not done anything for a while. They're the same price as they were back in 2015. So they've been flat for a decade. They pay a dividend. No dividend on this company. What do they sell? Is a development franchise licensing of, a QSR. They're a quick service restaurant. They sell chicken avocado burritos. That sounds amazing. Anything avocado, I love. The avocado toast is great. So let's see, Greater Los Angeles area. They get really niche with this. Wow. So if you're in LA, maybe you've heard of this company before. So that's where 72% of all the revenue comes from, Greater LA. And they're net income positive. You know what? I'm going to add them to the watch list. I like to see that. They're a $300 million company making a couple million, or what was the market cap again? Yeah, $318 million company making a couple million of net income every quarter. But the sales aren't growing too much. The sales are only up by 3%. Net income did fall, so the margins fell a little bit. But this is a pretty interesting stock. I mean, they're really small. I'd almost definitely rather own McDonald's than that one. But they're interesting, really interesting. Loco's a good value restaurant play. Hey, McDonald's has been doing a lot of work on their value offerings. So someone said Stag Industrial. This is a warehouse REIT. So they basically own a bunch of warehouses and they lease them out. So they're a triple net lease real estate investment trust. So when we go to their dividend right here, they have a 4% dividend yield, and it's actually completely sustainable because if you don't know, REITs have to, by law, pay out 90% of their taxable income in the form of a dividend to avoid paying taxes. And so they actually pay a monthly dividend as well. They're one of the few companies that pay monthly dividends. So yeah, they have a sustainable 4% dividend yield. Yeah, real estate operations. They're mainly in warehouses. So pretty cool. And here's how we can also just tell if the dividend is safe. They made $111 million of cash from operations. You don't look at net income for REITs because it doesn't include the depreciation and the amortization. And the dividend cost $71 million, so they can easily afford that dividend. So pretty cool. Again, those REITs though don't really outperform the market in the long run. Like you look at Realty Income. They don't usually outperform tech-heavy S&P. Sandwiches for $1 at participating locations. That's a great deal. I mean, that beats McDonald's offerings. Jeez. I wonder, Michael, are you talking about Wendy's or were you talking about El Polo restaurant? Best consumer companies? Well, there's consumer staples like Procter and Gamble, for example. Procter and Gamble owns so many like billion-dollar brands, like in random business, like they own the best shavers, like Gillette, or I think it's pronounced. They own Old Spice. Look how diversified this company is. Ultimate like consumer discretionary staple play right here, or consumer staple play, fabric and home care, baby, family care products, beauty products, health care, grooming. So really diversified revenue streams, and they print money, 3 to 4 bill. So there's $4 bill plus a net income a quarter, and you get a 2.5% yield. So let me put Procter and Gamble back on the watch list. They own Tide, Downy, pretty cool. So, hey man, thoughts on PayPal? Hey, good to see you, Audie. So let's do it. So this is PayPal right here. This stock is lower than it was in 2017. Isn't that crazy? Like that sounds crazy to say. But here's why I think PayPal is worth buying. It's not as a huge position, but I'll share with you the one thing I absolutely love about PayPal, and that's the share buybacks that they're doing. First off, they're a bit of slow growth because if we go to their total revenue right here, this is probably why they're trading at such a low valuation. The sales are only up by 5% year over year. So, 5% revenue growth, that's not, great, but it's this net income that they're making. They're making over $1 billion of net income a quarter, and it's their capital allocation. What are they doing with that $1 billion in net income a quarter? Well, since PayPal stock is, lower than it was in 2017, they're literally buying back $1 billion of their own stock every single quarter. That's the incredible part. Here's what that does for you as a shareholder. So the net income is up by 11.8% year over year. So net income's up by 11.8%. But net income per share is up by 19 because the share part of the ratio went down. And you own 7% more of the company than you did a year ago. So they've bought back 7% of all the shares. Insane. That's what I love about PayPal. So Lucas said, thoughts on First Solar, FSLR. So yeah, hey, I do need to plug in my phone. Thanks for that, V. FSLR. So First Solar, this is actually my favorite solar play. My second favorite solar play would be Enphase. But right now, solar's have been in a tough spot. They just took away credit, those tax incentives, credits basically for solar and wind. The administration is really bullish on nuclear right now. I think nuclear is really the energy business to be in. But First Solar is honest. It's, in my opinion, not financial advice. First Solar is the best solar pick out there that exists. Constellation Energy does own some solar assets, but they're mainly a nuclear play. But it's because of these net income numbers right here. They're making a couple hundred mil of net income every quarter. If you average it out here, easily 300 million plus in net income every quarter. So I do like First Solar out of all the picks, to be honest with you. So they're good. Thoughts on INDIE stock? Hopefully I can find that one. Wait, let me know. Are you talking about Indie Semiconductor or? Yeah, let me know if you're talking about Indie Semiconductor. They're a $900 million market cap. That's a very small company. So I would be careful with that one. Emox said, what about TCOM? TCOM, this is trip.com. I feel like I've heard of them before, but I don't know what they do. They're a Chinese company. So look at that though on the stock price. They're at an all-time high. So if you've ever owned the stock, you're definitely up on your position. Congratulations. So we'll convert their currency from Chinese to USD just so we can get a better understanding of the business. So yeah, the sales are up by 18%. They have so much sales, $2 billion. And on that, they made 700 mil of net income. They have ridiculous margins, a 33% net margin this quarter, and it grew 8% year over year. So they're printing money. Really good balance sheet. So who owns this business? Baidu owns some shares. Hey. But yeah, these net income numbers look great. I can see why this stock's at an all-time high right now. So trip.com, I assume it's some like travel. So let's see. It's a global one-stop travel platform. Cool. All right. So I've heard of, okay. SW seems interesting here. Wait, oh yeah, INDIE. So yeah, Indie Semiconductor. So yeah, this is a $900 million company. So very, very small market cap. Design, develops, and manufactures a broad range of integrated circuits. Okay, so here's where the revenue comes from. Do beware, 50% of the revenue comes from China. Then the US is 17%. But half the revenue comes from China. Do beware. Ooh, so here's why I actually can't touch this stock. So if you kind of remember this right here, the whole company is worth $980 million. So you can buy in at that valuation. Potentially, you could buy the whole company at a $980 million valuation. You're buying into a business. Let's say you own the whole business. You own a business that lost 40 mil of net income this quarter, 40 mil last quarter. It's burning through 40 mil of net income a quarter, all for a business that's not growing. The sales actually declined 1.4% year over year. So I'm seeing a lot of red flags on this stock. And again, that probably explains why they're not doing too well. So I think it's not worth 900 mil, or I could see how it not being worth 900 mil. Those net income losses are a bit scary. So SW seems interesting. What was SW again? Smurfit West Rock. Huh. So I haven't heard of this company, a $25 billion market cap. Hey, what up, Moses? So they do packaging. That's insane growth. They must have acquired a business to get that, but the revenue is up to $6.4 billion. They're also in the paper industry. Yeah, the paper revenue boomed as well. So really nice growth there. I wonder what happened. The net income, so they're actually maybe just from acquisition related stuff, but it says they lost net income this quarter. They didn't actually. They're technically making around 400 million of net income a quarter, so that's good news. They say they are interesting. Do they have a dividend? A 3% dividend. If we zoom out to them on the weekly, though, they're the same prices they were back in 2017. So they haven't really done much for a while. Okay. Webull stock and ADMA. We'll look at that one too. But yeah, Webull stock, that's ticker symbol BULL. I use their brokerage right here, so I've probably given them a lot of transaction fees and stuff like that. But let's see. Webull stock. They just reported earnings right here. They IPO'd not that long ago. Here's the good news. The good news is that they're extremely growthy. The sales grew by 45% year over year. So that was the good news. But I think investors weren't too happy with the net income loss. They made net income the past 2 quarters before this, but now they lost 30 mil this quarter. Brokerages like Interactive Brokers, Robinhood, Moomoo, they have 40% plus net margins, ridiculous margins. They're printing money, but they're not doing that yet, mainly because those businesses are into crypto and they make so much money from crypto transaction fees. Webull literally this month past week basically released that you can buy crypto on here again. And I think that that's going to be, oh yeah, hey, look, whenever I pull the app up, I hate when they do this little advertising at the top, but it says crypto is back at the top there. So they'll probably, here's my guess, not financial advice. I think maybe in the next couple quarters, they're going to raise their guidance from all the maybe crypto transaction fees that they're making. But also, I think anyone who wanted to do crypto has already done it somewhere else, because I used to own crypto on there. I used to own Chainlink on here and some other stuff. I don't own any crypto right now, but then they got rid of it and they lost. Anyway, let's keep going here. What are your top 3 suggested dividend stocks? So you probably won't love them for the high yield, because this is a dividend stock, but they have a really low yield. Like it says a 0.1% yield. Here's what's really cool. So yeah, the yield's really low, but every single January, like if you look right here, they did a 75-cent special dividend. That's why it says, instead of cash dividend, it says special dividend. Progressive makes so much money that they're doing these special dividends. And last January, they did a $4.50 special dividend. They can easily afford that, because if you look at the EPS right here, they're printing money down. The net income was at a new record, $3.2 billion. So Progressive is a great dividend growth company. Another kind of low yielding play. But look, I've been dollar cost averaging into this stock. All these little buy orders is every time I've bought this stock right here. Here's what's really interesting about this stock. I will share. Check out the yield right here. So they have a 0.68. We'll just round it up to 0.7. They have a 0.7% dividend yield, and the payout ratio is only a 5%. So a 0.7% dividend yield and only we'll just call it 6% payout ratio. Let's look at Apple. Apple has a lower dividend yield on only 0.44% dividend yield and 3x the payout ratio, a 16% payout ratio. So that's why I think Coca-Cola Consolidated, ticker symbol COKE, is a very cool dividend growth play. They're also massive on share buybacks. Here's how you can see, the net income is up by 8% year over year. So net income grew by 8%, but net income per share grew by 16. This company has bought back 8% of all the shares that exist in just the past year. I love shareholders. That's why I own a lot of them. They're way better, in my opinion, than the normal Coca-Cola stock that Warren Buffett owns. Oh yeah, Main Street Capital. Yeah, I'm sure you're asking me what's a better pure dividend play. Yeah, Main Street Capital is a really cool one that I think has a sustainable 5% dividend. They pay a monthly dividend as well. And then finally, I promise this is my last stock I'll share with you. Then we'll look at a few more of your stops like GENI. Check out some of these. It's actually TROW. This is T. Rowe Price Group. They're an asset manager, and they have a 4.7% dividend yield. And here's why I think they even have room to raise their dividends. So check this out. You get a near 5% dividend with this company, and this business is incredible. They're debt-free first off. So T. Rowe Price Group has no debt whatsoever, $3 billion of cash. They're making $500 million of net income a quarter. So debt-free company, $3 billion of cash, $500 million a quarter, and the dividend cost, their 5% dividend only cost $285 million. So they have a 50% payout ratio. So what are they doing with the rest of their money? Well, they're also buying back their own shares. They're so shareholder friendly. $100 million this quarter, $200 million last quarter. That's nearly the same amount they spent on dividends. So they're buying back their own stock and doing dividends with all their leftover money. So T. Rowe is, I don't expect them to outperform in the long run, but they're so shareholder friendly that I decided to buy them. VOOV what is this one? VOOV is the Vanguard S&P 500 Value ETF. Haven't heard of this one before. Let's see what it holds though. So its largest holding is notice it's not Nvidia. Nvidia is not even on here. In the normal S&P 500 and QQQ, Nvidia is the largest holding. So the first largest is Microsoft, then Apple, Amazon, nice, ExxonMobil, Berkshire Hathaway, J&J. Pretty cool. Actually, since we're over here, let's look at J&J. Someone just said Johnson & Johnson. So they've had some nice growth recently. They're recognizing some gains from their Shockwave acquisition, which best acquisition they've ever done. But yeah, look at this huge beat on revenue. This is what really impressed investors. Analysts were expecting $22 billion. They reported $23 billion, 23.7. They beat on EPS by 10%, or 7%. So yeah, they just really beat analyst expectations. Made $5.5 billion in net income this quarter. This is a a boring company, but they have a sustainable 3% yield. Like, check that out. You get a 2.9% dividend yield. You just kind of buy and hold Johnson & Johnson forever. No reason to like sell out of them. You should just get like 7% of your money back a year, CAGR. AFRM, it's up a lot. Hey, what up, JVM? What's up, guys? Hey, yeah, by the way, if y'all want to hit the follow button, we go live every day. Tomorrow is going to be really fun. We're going to do 2 streams on Sunday. So, hey, yeah, try not to spam here. Hold on here. Sorry, CEO. We'll check out, what's the ticker symbol? I don't know what that is. I don't know what Honest is. But anyway, here's Affirm. Yeah, they reported earnings. This is that buy now, pay later company. If anyone's heard of Affirm before, let's see how they did. I actually haven't looked at them. So big beat on revenue, big beat on EPS and EBIT. So triple beat. Great news. The sales were up by 33% year over year, and they made net income on this. So one thing that was a real concern on Affirm back in the day was the fact that they were losing a bunch of money, a couple hundred mil a quarter. Well, now that risk is gone. Affirm is making money, 70 mil this quarter. They're net income positive the past 3 quarters. They're really growthy. So the firm's really good, and that growth is expected to continue. It's supposed to be $1 billion in 2 quarters. That'll be very interesting. Oh, yeah, I forgot to check this one out. GENI stock. So, yeah, dang, my phone's getting low here. So here is Genius Sports, a $3 billion market cap. Let's check it out. So, we can't talk about this industry, but they're not making any money yet. So they've lost money every quarter for the past year. So we would like to see them start to narrow losses, but the growth looks nice. I mean, sales are up 25%. This is a bit of a regulated industry. If you look really close, that's what they do. But I can't talk about the industry anymore. I do apologize. Ooh, yeah, here's Harley Davidson. This is the motorcycle company. So Hog actually hasn't done too great. They're those same prices they were in 2020. So, yeah. Whoa. Wait, they're actually the same prices they were back in the year 2000. So, yikes. They have a nice yield, though, a 2.5% dividend yield, low payout ratio. Harley Davidson Motor Company. So, the sales are down by 22% year over year. If you look at this annual revenue, they had their lowest, like for the full year 2024, lowest amount of revenue even before 2021. So it looks like the business isn't growing. Yeah, yikes. The sales are down 19%. Luckily, they are still making net income, but dang, they lost 100 mil that quarter, and that was a real net income loss. And the net income's down by 50% year over year. So to be honest with you, nothing's really blowing me away here to really want to get exposure to motorcycles or get exposure to Hog. Thank you. Yeah, hey, no problem, Jason. I wonder if Marvel has a solid bounce off from earnings. So yeah, Marvel tanked 19%. I need to look into them more. Did they give guidance or something? Maybe if I can check the weekly brief here. Completes auto unit sale. Marvel and Broadcom expand custom chip production. Okay, let's go look at this company right here. So they're one of the cheaper chip plays out there. They're trading at like 23 times forward net income. So that's the thing. This company used to burn net income. If we zoom out, they used to lose net income every quarter. Well, now they're finally making net income every quarter. And basically, just assume this company's trading at 22 times net income. They're very undervalued, or cheaply valued relative to all their peers, and they're the same amount of growth. I mean, the sales are up by 57% year over year. I mean, they're basically like half. What's the market cap? They should be like half the size of AMD, but they're only worth 54 billion. This company makes AMD look so expensive. So I might actually look into Marvel. Actually, I thought they were on my watch list. They're on my other watch list, but I do like Marvel. They're finally starting to recover. And they also pay a dividend to a 0.4% yield. Affirm overvalued. Yeah, Affirm does look overvalued. What is VIGI? Vanguard International Dividend Appreciation. Let's see. So they own basically a bunch of international dividend paying stocks like SAP, Royal Bank of Canada, Mitsubishi, Nestle, Schneider Electric. I didn't know they were public. Schneider Electric. Anyway, that's like an international one. What is VYMI? International High Dividend Yield. What's this one on? Nestle, Roche, Shell. Both look good. I mean, I don't know. Both have good international stocks. They don't own any Chinese companies, though. There was this one, I think it's FTSE. Is it FTSE? Never mind. I don't know what it is. Oh, well. Hey, what up, Ace? DOOO, please. Is that a stock? This is BRP Incorporated. So that's a funny ticker symbol. Ooh. So this stock is lower than they were when they IPO'd in 2018. Unfortunate, but they have had a very nice recovery the past couple of days here, and they gapped up like crazy on Friday. Okay, so they reported earnings on Friday. Let's go see what the actual numbers were. So they beat on revenue. They beat on net income by nearly double, and they missed on EBITDA slightly. So sales are up by 5. And they did make net income. So actually, this is a Canadian company. To be honest with you, I'd be careful. I mean, they probably gave some good guidance or something, but nothing's really blowing me away here. The sales aren't doing great. They're not really making any money. The profits are down 30%, so margins are falling. I don't know. I got to do more research on that one. I apologize. Hey, Luis said Starbucks stock. So yeah, hey. Starbucks stock has been struggling with their margins. So that's why Starbucks has been flat for over 5 years on their stock. So they've actually not been able to afford their dividend, which is kind of unfortunate. Oh, we can see their number of stores. If anyone wants to guess, they have 41.1 thousand stores. And I'm about to end the stream here. I don't know why. I'm so tired. Hey, if y'all wanted the follow button, by the way, we stream every day. Tomorrow will be really fun. We're doing 2 live streams tomorrow. And by the way, I saw nothing. I have no course book, Discord, but the revenue is up by 3% year over year on Starbucks. Not great. So the revenue is up by 3, but here's the bad part in how they can't afford the dividend. The profits are down by 47%, which means the margins have collapsed. But kind of remember this number. It's they made 560 million of net income, and the dividend they have to make 693 million to even afford the dividend. So they couldn't afford the dividend the past 2 quarters, which is very unfortunate. So that's why I think that one either needs a healthy dividend cut or needs to recover from those huge net income losses. So yeah, hey, I'm going to end the stream here. I hope you guys have a great rest of your Saturday. Again, if you want to hit the follow button, mean the world. Hey, the best way to support me, very best way to support me is just subscribe to my YouTube channel. If you missed anything, watch the stream on replay. My YouTube channel is called Nathan Robert. It's also in the link tree in my bio. And yeah, hey, I'm streaming on YouTube and TikTok right now. I'm really trying to build up my YouTube audience. So yeah, if you would subscribe over there, I'd really appreciate that. We'll be live tomorrow. We're doing 2 live streams tomorrow. They're usually the most popular. Oh yeah, it's a 3-day weekend. We don't have a market open on Monday. We'll probably still stream on Monday. We'll stream on Monday when no one's streaming. So yeah, hope you guys have a great rest of your Sunday. I'll see you very soon. Yeah, hey, Lulu, Ace, Jason, Mikey, Michael, US Politics. Hope you guys have a great rest of your day. I'll see you very soon. See you later. Thanks so much. Hey, I got a new profile picture too, if y'all notice. Hey, thanks for y'all on the YouTube stream. Y'all are the best. I'm trying to build up the stream. Hit the like before you go if you see this. Thank you. Oh, dang, Michael, he said, look at STSS. Remind me to look at that. We'll look at it next time. Oh, I'm so sorry. My fault there. Next time, Michael, I didn't see that.